So, very good morning everyone, and our objective in this session will be the most important topics. The most important topics in direct tax. We will go through all the important topics from different chapters, and we will cover the important topics along with the past exam questions as well. This will be the objective of this revision session. So, first of all, we will start with the residential status. Let us understand which all are the most important topics in residential status, and I am planning to start with the determination of residential status of companies. That is the place of effective management concept. That will be our first concept. So, determination of residential status of companies, that will be our first topic. It has been tested thrice in the past examinations. So, I will say this is the first most important topic that we have to cover in this revision session. So, without wasting time, let us get started. Residential status of companies. Let us understand how to determine the residential status of companies. So, friends, the point is, let us understand how to determine the residential status of companies. So, listen, according to the theory, what we have to learn, a company is said to be a resident in India in either of these two scenarios. There are two situations where a company can be a resident in India. Situation number one, if a company is an Indian company, then it will be always a resident in India. What do you mean by Indian company? A company which is incorporated as per the company law or any other law prevailing in India. If you are an Indian company, then always you are a resident in India. That means all the domestic companies always will be Indian residents. And number two, for the foreign companies, there is a concept in income tax law, and that is called as place of effective management. So, friends, listen, if you are a foreign company, you will be considered as a resident if your place of effective management is in India. The concept is called as POEM. And what is the full form? Place of effective management. So, simply it means if you are a foreign company and your place of effective management is in India, then also you will be considered as a resident in India. Now, we have to understand how to determine place of effective management, and after determination of POEM, we will be solving some questions as well to get a grip over the topic. So, the place of effective management means what? Place of effective management to mean a place where key management and commercial decisions that are necessary for the conduct of business of an entity as a whole are in substance made. That simply means the place where managerial and commercial decisions are made. That place is said to be the place of effective management. Say for example, the company is doing some business in India. That doesn't mean that the company's place of effective management is in India. Doing business is the place where they do business. But the place where the management decisions are actually taken is said to be the place of effective management. So, let us understand how to determine the place of effective management. It simply means the place where your key management and commercial decisions are made. Okay, so let us identify how to determine this. So, basically, according to the concepts, a company, they themselves have to declare the place of effective management. It's very difficult for an outsider to understand where exactly the decisions are actually made. So, for an outsider, it will be an impossible task. But no company will declare this place of effective management by themselves, because if they become resident in India, then they have to pay taxes in India for their global income. So, what department does is, department have come up with a CBDT circular. There is a Central Board of Direct Tax circular, or we can say there is a circular issued by the CBDT to help the department to determine the place of effective management in certain circumstances. So, friends, listen, this is not a full-fledged determination formula. Okay, in certain circumstances, you can make use of this chart to identify the place of effective management. But for our examination, this is a full-fledged chart. You only have to study this chart, that is more than enough. This is for the purpose of examination. When it comes to the practicality, this is not a full-fledged chart. So, without wasting time, let's understand how to determine the POEM based on the CBDT circular. So, we call it as guiding principles for a determination of place of effective management. So, for determining the place of effective management, we have to first understand whether a company's active business is outside India or not. Outside India or not. So, friends, listen, why are we determining place of effective management? Because for a foreign company, it will become a resident in India if its place of effective management is in India. Place of effective management simply means the place where managerial and commercial decisions are in fact made. For determining place of effective management, the CBDT have come up with a circular. According to the circular, the first thing that you have to identify is whether a company's active business is outside India. So, depending upon the satisfaction of all these 4 parameters, we can say that either a company's active business is outside India or its active business is in India. So, let us understand how to identify a company's active business. For that, listen, a company shall be said to be engaged in active business outside India if all the following conditions are satisfied by the company. So, friends, it is very simple. If you are a company who satisfies all the following 4 conditions, then your active business is outside India. So, listen, you have to satisfy 1, 2, 3 and 4. All the 4 conditions have to be satisfied. If you are satisfying all the 4, then we can say that your active business is outside India. So, let us understand what is this condition number 1. What is condition number 1? If passive income is less than or equal to 50% of total income. For checking whether the company is satisfying condition number 1, you require 2 set of information. Number 1, you should have the total income of the company. Number 2, you should have the passive income of the company. You know what is total income? That is the total amount that the company earns in that particular previous year. That is said to be the total income. Now the question is, what is this passive income? So let's understand how to determine passive income. For determining passive income, there is a formula. Okay, there is a formula given by the CBDT, and let's understand what exactly is the formula. So you tell me in a common layman's language, what do you mean by passive income? A company can have 2 set of incomes, active income and passive income. So you tell me what is passive income. An income which is not active income is said to be passive income. Say for example, active income. I am a trader. All the profit that I am generating from sales is my active income. And I am a trader and I have invested something in my bank. The interest from that FD is a passive income. I am a trader. I am owning a building. The rental income that I am getting from the building is a passive income. The capital gain that I am getting from transfer of that particular building is again a passive income. So, passive income means all the other incomes that are not directly deriving from your operations. All the other income that are not directly deriving from your operations is said to be passive income according to the common layman's language. But the CBDT is defining the word passive income as well. So, let us understand what exactly is the definition for the passive income. So, listen. Passive income simply means income from transactions where both the purchase and sale of goods is from or to its associated entity. This is the first set of passive income. So, friends, please listen. Say I am an entity called TCS. Say I am TCS. And there is another company called Tata Motors, and there is another company called Tata Chemicals. And as you all know, all the 3 companies are under the same roof, that is Tata Group of Companies. Yes or no? So, Tata Group of Companies, imagine they have Tata Motors, Tata Capital Services, Consultancy Services and Tata Chemicals. Now, this TCS is buying some good from Tata Motors and they are selling the same goods to Tata Chemicals. So, this TCS is buying goods from Tata Motors and is selling this to Tata Chemicals. So, if we analyze this, we can say that from the perspective of TCS, purchases are from associated entity and they sold the goods to the associated entity. So, all the profits that they are deriving from this activity is said to be a passive income. If you have an income where both the purchase and sales are to or from your associated entity, we can say that that is what your passive income. If both the purchase and sales are to or from associated entity, then all the profit that you are earning from that particular activity can be called as what? Passive income. And friends, listen, there is one more thing. You have to be careful. Say TCS is buying something from Tata Motors and selling it to outside. Can you call this as passive income? No. Both the purchase and sales R2 or from your associated entities, both the purchase as well as sales, both should be there. See, what is the logic behind this passive income? Department said TCS is not doing anything. If Tata Motors wants to sell something to Tata Chemicals, they can do directly because both are under Tata only. Why they are making use of TCS? It's only for the sake of doing transaction. They are accommodating TCS in between. So this TCS is actively not doing anything. So that's why if you are earning some income from purchase and sale happens between associated entity, then that income is not your active income because you are not doing anything. It is said to be passive income. So income from transactions where both the purchase and sale of goods is from or to your associated entity, then that is the first set of passive income. And there is one more set of passive income, and let's understand what is the second set. So read this along with me. Income by way of royalty, dividend, capital gain, interest, except for banking companies and public financial institutions, or rental income. So listen, all the royalty income, all the dividend income, all the capital gains. In relation to interest, there is an exception. And what is the exception for interest? Except for banking company and public financial institution. If you are a bank or a public financial institution, then the interest income will not be your passive income. Why? Because for a bank, their direct operational income will be interest income. So there is an exclusion for the bank in respect to interest income. So for a bank, interest income is not passive. For all others, interest income is definitely passive. And finally, rental income. So all these incomes are the passive income. Now let's go back to the original condition. What was the original condition? Now you know what is passive income. You have to take the passive income and you have to compute the total income. The percentage of passive income to the total income should be less than or equal to 50%. If your percentage of passive income and total income is less than or equal to 50%, then we can say condition number 1 is definitely satisfied. Are you all with me? Now let's understand what is condition number 2. Alright, now why we are checking this condition? Because we should compute whether the company's active business is outside India. If the active business is outside India, then the POEM determination is in a way. And if the active business is not outside India, that means if it is in India, then your determination of POEM also varies. So let's check the second condition. What is second condition? Assets in India is less than 50% of total assets of the company. That simply means, friends, listen, you are a company and your Indian assets or assets which are located in India is less than 50% of the total assets. How do you find out the value of assets? Very simple, you open the balance sheet. You open the balance sheet and take the total value of the assets. And you check whether assets in India to the total assets, the percentage is less than 50%. There is no equal to over here. There is no equal to over here. The point is very clear. It is less than 50% of total assets. Equal to is not there. So we have prepared this chart based on all the technical and key elements. As you can see, everything is in the chart form. All the explanations that we are about to do in this session will be by making use of these charts. Okay, so this will actually help you to revise the concepts in time. Rather than reading paragraph, these charts will definitely help you to quickly complete your revisions on time. Now, getting back to the second point, assets in India should be less than 50% of the total assets of that particular company. Then, what is condition number 3? Number of employees situated or residents in India is less than 50% of total number of employees. So, condition number 3 is very simple. First you go and find out what is the total number of employees in the company. Then you check out of the total number of employees, how many number of employees are either situated in India or residents in India. If the percentage is less than 50%, then it's fine. That simply means your majority number of employees are outside India. So condition number 3 is also satisfied. And what is condition number 4? The payroll expenses incurred on such employees. What do you mean by such employee? That means the employees who are situated in India or residents in India as above is less than 50% of the total payroll expenses. You go find out the total payroll expenses. Out of the total payroll expense, you find out how much is the amount of salary that you are paying to employees who are either situated in India or residents in India. And here one more thing, employee includes contractual employees as well. If they are providing similar service to that of your normal employees. Say for example, a company have normal employee and contractual employee, and both of them are providing the same service. Then both have to be counted for the purpose of determining condition number 4. Are you with me? This has been provided as notes. Okay, you can see a lot of notes over here, and all the relevant notes have been provided by way of a table format over here. So the point here is 4 conditions are there. Let's understand which all are the 4 conditions. Again, number 1, passive income should be less than or equal to 50% of total income. Condition number 2, assets in India should be less than 50% of total assets of the company. Condition number 3, number of employees situated in India or residents in India less than 50% of the total number of employees. And condition number 4, payroll expenses incurred on such employees in India as above. That means payroll expenses for those employees who are situated in India or residents in India should be less than 50% of the total payroll expenses. If all the following 4 conditions are satisfied, then what is the conclusion? Your active business is outside India. And one more thing, if any of the above conditions are not satisfying, then what is the conclusion? Your active business is in India, or we can say it is not outside India. That means it is in India. So if all the following 4 conditions are satisfied, then let's understand how to determine the POEM. So if active business outside India, that means all the following 4 conditions are satisfied, then how do you determine POEM? Then what department says is POEM shall be outside India if the majority of the board of directors meeting are held outside India. Simply friends, it means your active business outside India plus majority board of directors meeting are also outside India. If both the conditions are satisfied, then what is the conclusion? Your place of effective management is also outside India. So it is a pretty simple point. Your active business is outside India plus majority board of directors meeting are also outside India. Then you tell me what is the conclusion? Then the place of effective management is also outside India. But there is one twist is there. Let's understand what exactly is that particular twist. However, instead of board of directors or instead of board, such powers are being exercised by someone else in India. That means there are some dummy board of directors. What do you mean by dummy board of directors? There are board of directors, they are also conducting board meeting, but they are not actively involved in decision making. These decisions are taken by a person who is a resident in India. Actual decision maker in your company is a person resident in India. If that is proven, the department will say that your place of effective management shall be considered to be in India. If the actual decision maker in your company is not board of directors, they are standing aside. They are standing aside, they are not the actual decision makers. In that sense, the place of effective management shall be considered to be in India. This is what the department says. Now, there is one more note under this. Let's understand what exactly is note. This note is related to this point. Okay. If board of directors follows general and objective principles of global policy of a group laid down by the parent entity, which may be in the field of payroll functions, accounting, human resource functions, IT infrastructure, network platform, supply chain function, routine banking operational procedures, and not being specific to any entity or a group of entities per se, would not constitute the case of board of directors of the company standing aside. Simply means, friends, listen. I'll give you an example for a better clarity over this topic. Say Reliance Industries Limited India. Okay, they have incorporated a company in France. They have incorporated a company in France. All the shares of this company are held by Reliance Industries Limited. Now, there are actually 2 companies. One, Reliance Industries in India, and number 2, France Incorporated in France. Are you with me? Now the question is, Reliance Limited India anyways Indian resident, because they are incorporated according to our Indian law. Now the question whether this FRA Incorporated is a resident in India. Say this FRA Incorporated is doing business outside India, or we can say they are doing business in India. Their active business in India. Their active business is in India. Are you all listening? Say this FRA incorporates active business where? In India. They are incorporated outside India, but they are doing some business in India. And the board of directors meeting Whether it is a criteria or not, let's understand. Okay, when it comes to the chart, first chart what they are saying is if active business is outside India. So, we will stick on to the first chart now. So, I will change the assumption active business outside India. Okay, active business outside India. So, Reliance Industries have a subsidiary company France Incorporate and its active business is outside India. Now, the point is normally the decisions of this France Incorporate are taken by the board of directors which should be in France. Yes or no? And the board of directors meeting have to be held in France. Reliance Industries is only an investor in that company. Okay, Reliance Industries are only investors of that particular company. They are shareholders of that particular company. Now, but the point is, the France Incorporate have some board of directors. All the board meetings are held in France, but they are not taking any decisions. Only for the purpose of conducting meeting only they are conducting this board meeting. They are coming, conducting board meeting, saying Tata bye bye. All decisions are taken by Reliance Industries. Then the department will say, even though the company is active business outside India, even though all the board of directors meeting are outside India, we know that the decision maker is an Indian, and hence what will happen? We will call this French company as a Indian resident foreign company. Their income determination will be as same as that of a resident. Their total income will be same as that of a resident, but the rate of tax will be at 40%. Why? Because they are now an Indian resident foreign company. They have to pay taxes at 40% only, but their total income determination will be as the same as that of a resident. Are you all here? So, all the global profits of this France Incorporated will be taxable in India. This will be the impact. But there is one thing. Say for example, all the subsidiary companies of Reliance, are using some lay down principles. Say for example, imagine KFC, Kentucky Fried Chicken. In wherever you go, you can see their same uniform, same drilling procedure, same pattern they are following. Okay, these are group laid down policies. If a subsidiary company is following a group laid down policy, that doesn't mean that subsidiary companies' board of directors are dummy. That is perfectly alright. The board of directors are there, they are taking decisions also. But if you are a subsidiary company of a group and the group has laid down certain standard procedures in the field of either payroll, accounting, human resource, infrastructure, network platform, supply chain, routine banking operation procedures, we call it as standard operating procedures. If a subsidiary company follows a standard operating procedure, that doesn't mean that subsidiary company's board of directors are dummy. All other functions have to be taken according to the approval of the board of directors of the subsidiary company, except in these fields. If they are following a standard laid down procedure, don't say that the board of directors are dummy. It's perfectly fine. That's what the department says. I hope that point is clear for you. Now, the point is very clear. Active business is outside India. Majority board of directors are outside India. POEM outside India. If the board of directors are dummy board of directors and the actual decision makers are Indian residents, then you tell me what is the impact? Very simple. The POEM will be in India and they will become residents in India. Now friends, let's check the other alternative. What is the next alternative? If active business is in India, say you are a company and you are not satisfying any of the following 4 conditions, then what is the conclusion? Your active business is in India. If your active business is in India, then POEM shall be determined in 2 stages. Stage number 1, stage number 2, or we can say 2 steps. You have to give importance to both the steps for determining the place of effective management. Let's understand what all are the steps. Number 1, identifying the persons who actually make key management and commercial decisions for the conduct of the company as a whole. So, what the department say, if you are a company and your active business is outside India, then you follow these 2 steps. After following these 2 steps, the department, by making use of their discretionary power, have to determine the place of effective management. This is not a formula. You consider these 2, then you give weightage. Based on that, department themselves have to determine the place of effective management based on the actual facts of the circumstance. There is nothing called some percentages or fixed parameters are not there. By considering these two things, you determine the PO, EM, that's what the department says. Which are the two things that have to be considered? Number one, identifying the persons who actually make key management and commercial decisions for the conduct of the company as a whole. You go identify the actual decision makers of the company. That is point number one. And what is point number two? Determine the place where these decisions are in fact made. So you go find out these two. Based on these two, you determine the place of effective management. There is no equation and all. It's not a fixed parameter. Based on the actual facts, by looking into these two parameters, AO themselves have to determine the PO, EM. That's what the department says. I hope that point is clear. I'll repeat that point again. Listen, what they are saying. Number one, identify the persons who actually make the decision. Number two, determine the place where the decisions are in fact made. By giving importance to these two parameters, determine the POEM. How to determine the POEM based on these two parameters? That is not mentioned in the circular. They are only saying focus on these two. Then based on these two, you determine the POEM. That always happens based on the actual facts of a case. That's what I can say. So I hope this much is clear for you. So everything happens around that word called POEM. That is actually intended for a foreign company. And what is the purpose of that word? We want to check whether a foreign company's residency status is in India. For that, we have to determine the place of effective management of that particular foreign company. And how do you determine the place of effective management? First of all, go find out the ABOI. If the active business is outside India, then what to do? Therefore, determining the active business is outside India or not, you have to check four conditions. Which are the four conditions? Passive income should be less than or equal to 50% of the total income. Number two, assets in India should be less than 50% of the total assets. Number three, number of employees situated or residents in India should be less than 50% of the total number of employees. And what is number four? Payroll expenses incurred on such employees in India as above is less than 50% of the total payroll expenses. If all the following four conditions are satisfied, ABOI, active business outside India. And active business outside India, majority of the board meetings are held outside India. POEM, outside India. Active business outside India, majority of the board meetings are held outside India, but the board of directors are dummy and the active decision makers are Indian residents. Then that company's POEM will be in India. If the active business is in India, then based on two parameters, you determine the POEM. Which are the two parameters? Identify the decision makers. Number two, determine the place where they are taking the decisions. And for the whole POEM, the meeting held by the shareholders are irrelevant. Wherever the shareholders conduct AGM, EGM, etc. is irrelevant for determining POEM. I hope you got my point. The place of AGM, EGM is irrelevant for the determination of place of effective management, and I hope that is also clear for you. Yes, so let's solve a past exam question. So it is actually 6-mark question tested in November 2019. So I want all of you to go through this ABC limited question and just give me the answer. So this is the question. It's a past exam question that is tested in November 2019 for 6 marks. So go through this question and give me the answer. Moving on to the answer, friends, I have given you this question number 19. So let's solve it together. ABC Limited, a software giant in India, set up 100% subsidiary company by name SHD Incorporated in Switzerland on 1st April 2022. The subsidiary company SHD Incorporated is mainly engaged in the software services, hardware services and data backup services in 3 different countries, that is Switzerland, Sweden and India. The following information is furnished by SHD Incorporated for financial year 23-24. Value of assets, number of employees, payroll expenditure, aggregate income earned, other information is also given. During 23-24, total 5 board meetings were held, 2 in India, 1 in Sweden and 2 in Switzerland. Based on the above information, determine the residency status of SHD Incorporated applying the provisions of POEM for assessment date 24-25. So friends, for determining place of effective management, what is the first thing to check? Whether active business outside India or not. So in examination, you have to write the notes. Writing notes is very important. So we are determining whether company is active business is outside India or not. For determining whether a company's active business is outside India or not, we have to satisfy 4 conditions. What is condition number 1? Passive income should be less than or equal to 50% of total income. Now let's understand and let's compute what is the passive income. And what is passive income? So here passive income means income from transactions where both purchase and sale are from or to associated entity. Both purchase or sale are from or to associated entities. Can you tell me how much is the income where both the purchase and sale are to or from associated entity? Breakup of total income is given in the question. Number 1, 28 crore derived from transactions where purchases are from A, sold to non-A, not passive. 24 from transactions where both the purchase and sale are made from or to A, this is passive. 16 crore derived from transactions where purchases are from non-A, not passive. 8 crores by way of income from capital gains, passive. 4 crores by way of interest from non-A, passive. So how much is the passive? 24 plus 8 plus 4. So we will write 24 plus 8 plus 4 and it will be 36 crore. And how much is the total income? That is directly given in the question. Total aggregate income is 80 crore. So total income given in the question will be 80 crore. Now let's check the percentage. 36 by 80. How much is the percentage? 45 point something is there, or exactly 45. 45 percentage. So condition number 1 is definitely satisfied. Yes or no? Now we will understand whether the company is satisfying condition number 2. And what is condition number 2? Assets in India. This you have to write in exam, okay? Should be less than 50% of total assets of the company. For that we require assets in India. Is the assets in India given in the question directly? Yes. Everything is directly given in the question. This is only an easy question. You can easily grab 6 marks if you know the concept. So asset in India. How much is asset in India? Value of assets as per the books of accounts is 24 crore. So 24 crore is the only assets in India. Can you tell me how much is the total assets? So it is 24 plus 12 plus 24, and how much it will be? 60 crore, right? 60 crore is the total value of assets outside India or all over the globe. So 60. So what is the percentage? 24 by 60, 40%, and the condition number 2 is also satisfied. By looking at the figures itself, it's very clear that it is less than 50, but you have to compute the percentage. That percentage computation carries a mark in exam. Okay, so condition number 3, let's jump to condition number 3. And what is condition number 3? Number of employees in India should be less than 50% of total employees, right? Now, how many number of employees are there in India? Number of employees in India is 28 crore. 28 crore is the number of employees in India. So you have to take that 28. And how much is the total number of employees? 28 plus 10 plus 30, and that will be 68 crore. So 68 crore is the total number of employees. And what is the percentage? 28 by 68, and that will be 41.176%. And condition number 3 is also satisfied. And you tell me what is condition number 4? Condition number 4, it says the payroll expenses of employees in India should be less than 50% of the total payroll. And how much is the payroll expenses of those employees in India? It's only 5.4, right? Payroll expenses of those employees in India is 5.4 only. So 5.40 crore. And how much is the total payroll? 5.4 plus 2.6 plus 4. How much it will be? 12 crores. So 5.4 and 12 is there. So can you tell me how much is the percentage? 45%, and that is also satisfied. So what is the conclusion? All the following conditions are satisfied. So active business outside India. Now you tell me, where is the majority board of directors meeting happened? So 5 board meetings were held. 2 in India, 1 in Sweden, 2 in Switzerland. So number of employees, out of total 5 board meetings, 3 happened outside India. Yes or no? Don't say that India 2, Switzerland 2, so it's a tie. The only thing that you have to do is within India and outside India, all together, whether majority happens outside India. And here 3 board meetings happened outside India. And what is the conclusion? POEM is outside India. We don't know which country can enjoy the POEM, that we don't know, we don't have to know, because this is Indian income tax. We only have to decide our things. So we are concluding that since majority board of directors meeting outside India, then what is the conclusion? POEM outside India. If you write this much, you can score 6 marks. That's it. I hope it is clear. Moving on to the next important topic according to my evaluation is section 9. We should understand the importance of section 9 because that is very crucial for us. So let's analyze section 9. It's actually a huge section. We have lot of concepts involved in this particular chapter. Technically, this is your NR taxation. Okay, this is your non-resident taxation, but according to our chart book, it is residential status and scope of total income only. That is chapter 2. So let's understand what is this section 9. So before we start section 9, let me give you an intro of section 9. Why we require section 9? So friends, please listen. If you are a non-resident, your total income determination will be based on 2 parameters. Okay, either income accrued in India or it should be first received in India, or it should be first received in India. That simply means if you are a non-resident, then your scope of total income in India, or we can say in simple language, we can say if you are a non-resident, then income will be taxable in India, either only if it is accrued in India or it is first received in India. What do you mean by accrued in India? Accrued in India simply means the right to receive the income should be from India. Right to receive an income should be from India. Now, what is this first receipt? That simply means you earned an income outside India. First receipt simply means you earned outside India, but the person make the payment. In India. You receive that payment when you are in India, or you receive that payment to a bank account which is maintained in India. Are you with me? That is said to be first receipt. There can be one more possibility. You receive that income outside India, thereafter you transfer that amount into India, that is not a problem. Say for example, I am a person in Dubai, earned a lot of income from Dubai. I took some income and went to India for a tour. Do I have to pay taxes for bringing that amount to India? No. If that amount is first received in India, then definitely you have to pay the taxes in India. Or if a service is provided in India, then definitely you can say that income is accrued in India. The subsequent transfer of money back to India is never taxable in India. Now, section 9 says income deemed to be accrued in India. So, section 9 will come here. The following are deemed to be accrued or arised in India. What do you mean by deemed to be accrued or arised? Irrespective of its actual place of accrual, we are stating that in the following circumstances, following incomes shall be deemed to be accrued in India. It's a deeming fiction. That means irrespective of its actual place of accrual, irrespective of the place where it is received. We don't care. We are saying that all the following income shall be always deemed to be accrued or arised in India. Let's learn each and everything in a very detailed manner. Even though it is a revision session, I want all of my students to understand the concept in a very detailed manner. So we will quickly go through section number 9 and we will solve some past exam questions to get a better grip over the topic as well. So what is this? Income deemed to accrue or arise in India, section 9, subsection 1. Let's understand which all are the circumstances. Circumstance number 1. Income accruing or arising outside India directly or indirectly through or from any business connection in India. What department says is, say for example, you are a non-resident and you are earning some income outside India. You are earning some income what? Outside India. This earning outside India due to business connection in India. Say for example, I am a company and I am selling products and I am from outside India. I am in France. I am a company incorporated in France and I am selling my products outside France. I send an agent. I have an agent in India who takes care about the sales, who is just like a marketing person. Okay, so I am a French company in France and I have appointed an agent in India. Agent in India, this person sells goods or identify customers in India. I am a company from France and I sell goods from France, but I have appointed an agent who either sells on my behalf or he identifies customers. If in this case, I can say that this agent in India will be the business connection of this French company and all the profits that this company earns through this agent shall be deemed to be accrued or arised in India. So we can say, if you are a non-resident and having a business connection example like an agent in India, then what department say? All the profits which are attributable to business connection shall be deemed to be accrued or arised in India. This is what the department says. So one more thing is there. Say I am a non-resident French company and my global profit is say 1000 crores. My global profit is 1000 crores. Out of this 1000 crore, only 10 crore is due to this business connection. I have earned 10 crore by making use of this agent's services. Now you tell me how much is deemed to be accrued or arised in India? The full 1000 crores or 10 crores? 10 crores. That's why I have written all profits which are attributable to the business connection shall be deemed to be accrued or arised in India. All the profit that you have earned through the business connection or through the agent or due to the activities of the agent alone shall be deemed to be accrued or arised in India. This is what the department says. Now friends, listen. There are certain pluses and minuses in this business connection and let's understand what exactly are the pluses and minuses. These are the definitions of business connection. Okay, I don't want to go to the definitions, but rather we will stick on to some important concepts under this topic. So the first important sub-concept is significant economic presence. So listen friends, nowadays due to the advancement of the technology, we don't have to send an agent physically to India. We don't have to send an agent physically to India. Rather, we can digitally present in India. There can be a digital presence in India. So to avoid that or to incorporate that digital presence also under business connection, department is explaining a thing called significant economic presence. Let's understand what is that. So significant economic presence of a non-resident in India shall also constitute business connection in India. If you are a person, that means a non-resident, you have significant economic presence in India, then that also shall be considered as what? A business connection in India. Now you will ask me, what is the significant economic presence? There is a definition for that particular word. Let's understand what exactly is the definition. So the concept is simple. You are a non-resident. Either you have a business connection like an agent physically present in India. So all the profit that you are earning through that agent will be taxable in India. Or you don't have an agent, but you are significantly present in the economy. That is called as SEP, significant economic presence. You have SEP in India. That also will be considered as a business connection, and all the profits that are attributable to the SEP shall be deemed to be accrued or raised in India. Now let's understand what is the definition for the word SEP. So let's understand what is the definition for SEP. So listen friends, what is SEP? Significant economic presence means, number one, transaction in respect of any goods, services or other property carried out by non-resident in India, including provision of download of data or software in India, and the aggregate of payment arising from such transaction or transactions during the previous year exceeds 2 crore. Very simple. Listen, you are a person and you are selling some goods or providing some services in India. Say you are a French company, you don't have an agent in India, but you are about to make some sales or you are about to provide some services to Indians, and the value of goods sold or the value of services that you provide in a year exceeds how much? 2 crore. Even without physically present, you are able to make 2 crore sales in India. More than enough. That is considered as a significant economic presence. Maybe by way of a website. You are digitally advertising and you are providing a website in India. The customers who are interested can directly log on to the website and purchase the products. The customer does not have to visit France, or the company does not have to come to India. Even by sitting in France, they are able to generate profits in India. That concept is called as what? SEP, significant economic presence. So if you are about or if you are able to sell goods or provide services and the value of the goods or services in a year exceeding 2 crore, that will be considered as what? Significant economic presence. Are you all with me? So the significant economic presence shall become a business connection, and all the profits through this activity shall be deemed to be accrued or raised in India. Now there is one more thing. What is the second SEP? Systematic and continuous soliciting of business activity or engaging in interaction with users in India through digital means. Tell me, what is this soliciting? What do you mean by soliciting? That means advertising. You are advertising your business by either it can be a good or it can be some services. You are advertising something and you are interacting with minimum 3 lakh users. Are you all here? You are interacting with how much users? How many users? 3 lakh users. What do you mean by interaction with 3 lakh users? Say for example an Instagram ad. We don't know how many interactions are there. We can easily know by checking in the Insta dashboard. There is a thing called dashboard. So in the dashboard you can see how many interactions are there, and you are continuously interacting with 3 lakh users. Every advertisement there is an interaction of 3 lakh users, more than enough. Department say you are digitally present. Okay, all the profits from that, all the conversions, all the interactions will not lead to any profits. Interaction, that person may or may not become your customer. Some persons will simply visit the website, okay, for getting the information. Thereafter they will leave the website without making any transaction. So if you are able to generate some transactions from that activity, that also shall be deemed to be accrued or raised in India. Are you with me? So two things are considered as significant economic presence, and tell me which all are the two things. Number one, you are about to sell or provide some services and the value of the sales or the services in a year more than 2 CR. Number two, you are not selling anything, but you are interacting continuously with minimum 3 lakh users in India. That also will be considered as significant economic presence. So if SCP is established, then we can say that SCP will become the business connection. All the profits that are attributable from the business connection shall be deemed to be accrued or raised in India. I hope that point is clear for you. Now Now, not yet over. There are a few more things in relation to this. Okay, so let's understand what exactly are the other few things. There are certain pluses and minuses over here. So let's understand the negative list. Negative list. So what is negative list? The following shall not be treated as a business connection. The following circumstances, department will blindly say that there is no business connection. We can call it as what, friends? Negative list. Okay, so friends, listen, one important thing is there. Say you are not there in the negative list. That means what? If your business is not there in the list of negative list, then what is the meaning? That doesn't mean that you have business connection. If your business is not coming under any of these four circumstances, then based on the actual facts of the case, you have a business connection or not. Are you with me? But if you are covered in the negative list, then you are safe. You will be never considered as a business connection in whatsoever manner in India. Are you with me? If you are not there in the negative list, that doesn't mean you have business connection. You are having business connection always depends upon the actual facts of the case. How you are designing, or how we are able to do your transaction. Based on that actual fact only, the business connection is established. So let's come back to the point. So the following shall not be treated as business connection in India. And what all are the items that comes under negative list? Number 1, purchase of goods in India for exporting. We are purchasing goods in India for the purpose of exporting. Simply means you are a non-resident company or you are a non-resident businessman. You are sending a person to purchase some raw materials from India. Okay, you are sending a person to purchase some raw materials in India. Say for example, Rolls-Royce. The company Rolls-Royce is purchasing wood from Kerala, Nilambur. They are purchasing teak wood from Nilambur. So Rolls-Royce representatives will come to Kerala and they will verify the quality of the teak wood. And if once it is approved, they will export it to India. Department will never say that Rolls-Royce have a business connection in India, because their representatives are coming to India for purchasing raw materials for the purpose of export outside India. That will never be considered as a business connection in India. You are safe, Rolls-Royce. Are you with me? If you are purchasing the goods from India for the purpose of export, that will never be called as a business connection, because we want to promote the exports. If we call it as business connection, these people will not come to India. They will find out what alternatives from some other part of the world. So we are saying that you are safe. You come, purchase, go out. We will never call it as what? Business connection. Number 2. Can you read the second point? Collection of news and views in India for transmission out of India. I'll give you an example for a better understanding. BBC, British Broadcasting Corporation. They have what? They have some operations in India. But right now they have shut down all the operations, but still they will cover important events in India. Say there is some, India-Pakistan meeting is about to happen. Imagine India and Pakistan Prime Ministers are meeting in India, almost an impossible thing. Okay, but imagine in future, both the Indian and Pakistan have taken an initiative and they are coming and meeting in India. Definitely BBC correspondent will come to India and cover that event. And they will collect the news for the purpose of broadcasting it outside India. So collecting that news for the purpose of broadcasting it outside India will never be considered as a business connection. It is also outside the scope of business connection. Department will never say, BBC, you are getting information from India. You have a connection. So all the profits that you are generating due to broadcast of this news will be taxable in India? No. We are not saying, we are not that cruel. You collect news, transfer it outside India, we don't care. We are not calling it as what? Business connection. Are you able to follow? Are you able to follow? Great. And what is point number 3, friends? And point number 3 is actually a little bit sensitive. It is only applicable for a foreign company that too engaged in the business of mining of diamonds and activities which are confined only to display of uncut and unassorted diamonds in a special zone notified by the central government. Lot of keywords are there. First of all, you have to be a foreign company. Where is that? Yeah. You have to be a foreign company. And what should be your business? Mining of diamonds. And what should you do? You should display uncut and unassorted diamonds in a zone notified by CG. You are displaying. So during the process of mining, you got some rare piece of diamonds. Okay, that raw diamond. What do you mean by raw diamond? Uncut and unassorted diamond, diamond means raw diamond. Diamond after cutting and polishing will have that shine. Okay, so the raw form you are displaying, it in a zone notified by CG. That activity will be never considered as a business connection you are saying. If you are doing something else, then you may end up in business connection. But this activity will never be considered as a business connection. You have to be a foreign company and your business should be mining of diamonds. You should get some raw unassorted diamond. You should display it some zone notified by the CG. Not a business connection. This activity is never regarded as a business connection in India. And moving on to the last negative list, and you tell me what is the last negative list? Shooting of any cinematographic film in India by a non-resident. If it is an individual, then should not be a citizen of India. Say for example, Slumdog Millionaire or Mission Impossible, that Ghost Protocol movie. So movies like this or Life of Pi, these movies are actually Hollywood movies but shot in India. Hope you know the Slumdog Millionaire movie, the Oscar winning movie. That's actually a Hollywood movie but shot in India. So you are shooting a cinematographic film in India. That activity is never regarded as business connection. It is there in the negative list. But there are certain conditions. If the producer of the movie is an individual, that individual should be a non-resident, non-citizen. If the producer of the movie is a partnership firm, then none of the partners should be a citizen or a resident. If the producer of the movie is a company, then none of the shareholder should be a citizen or a resident in India. That means if the movie owned by, if cinematographer film, if such non-resident is an individual, that means who owns the movie? The production team. The producer, individual, NR, not citizen. Firm, none of the partners should be a citizen or resident. Company, none of the shareholders should be a citizen or company. For example, this Mission Impossible movie is actually the producer at Tom Cruise production. Say it is a company. None of the shareholders of the company is Indian residents or Indian citizen. Then only due to that shooting a cinematographic film in India, that will be never regarded as a business connection. Now you tell me, what if one of the shareholders is an Indian citizen? Then what will happen? Then they may end up in business connection. That is the perfect word. They may. Why may? They are not in negative list. That doesn't mean that they will come under the business connection definition. Hope you got the point. You can expect some MCQ or one word things from here. Okay, that's it. But the word business connection is actually a little bit important. So this is what is the concept of business connection, and let's quickly revise the concept of business connection again. So business connection comes under section 9. Income deemed to accrue or arise in India. Under that, what is first circumstance? Income accruing or arising outside India directly or indirectly through or from business connection in India shall be deemed to be accrued or arised in India. You have a business connection. Due to that business connection, you are earning some profits. All the profits that you are deriving or you are generating due to your business connection shall be deemed to be accrued or arised in India. It is as simple as that. Moving on to the second scenario. And what is the second scenario? Can you read the second scenario? AD, that means income accruing or arising outside India directly or indirectly through or from any property or asset. This is one word only, okay? Asset or source of income in India. That simply means, listen, say I am a French resident. I bought some Indian company debenture, okay, from France. I'm a person from France. I bought some debentures in France, but the debenture is of Indian company. I bought it from French market. Okay, I'm getting some interest. I have never seen India. Okay, I haven't seen India in the map also. Doesn't matter. The debenture is an Indian company's debenture. That is an asset located in India. So all the income that I am getting, that interest income that I am getting from that particular debenture shall be always deemed to be accrued or raised in India. I am saying that I don't know where India is. We don't care. You have some interest from an Indian located asset, more than enough. You have to pay taxes in India. Are you with me? So you are generating some income outside India due to any property, asset or source of income in India, that shall be deemed to be accrued or raised in India. That's what the department says. Moving on to the third scenario. What is the third scenario? Transfer of capital assets situated in India. You tell me, what do you mean by transfer of capital assets situated in India? The same example, I am selling that debenture. I am a French citizen, French resident. I sold that Indian company debenture in France. Another French resident bought it. You think about the seller's perspective. I'm a French person, French citizen, French resident, bought some, sold some Indian company debenture. All the profits that I am getting or the gains that I am getting from transfer of that debenture shall be deemed to be accrued or raised in India. Either I am getting interest income or I am getting some capital gain on account of transfer of that capital asset. Both are deemed to be accrued or raised in India. Are you with me? Are you with me? So both the interest income as well as capital gain on account of transfer of the capital asset, both are taxable in India. One more thing is there. We have a huge explanation for the third box over there, and let's understand what is the huge explanation under the third box that is tested twice. That has been tested twice in NR taxation. So let's understand what exactly is this point. Listen. So listen friends, income through transfer of capital assets situated in India. This is actually a little bit important and this is a little bit confusing also. So I want all of you to be super attentive right now. So listen friends, see they are giving some explanations under this. Let's read the first point. Capital asset being shares of a foreign company shall be deemed to be an asset in India if such share or interest derives directly or indirectly its value substantially from assets located in India, provided on the specified date the value of asset in India exceeds the amount of 10 crore and represent at least 50% of the value of all the assets owned by the company or entity. I am sure that you will not understand anything by simply reading this paragraph. Rather, I will make use of an example, okay? And I want all of you to be interactive. I want all of you to give me replies. So listen, say there is a company called France Incorporate. There is a company called France Incorporate. Now listen, and I am Mr. Shareholder. I am Mr. Shareholder of this particular company. I am Mr. Shareholder of this particular company. Now you tell me this company is a French company. Yes or no? This company is actually a French company. And the shareholder is a shareholder of a French company. I sold the shares. I sold the shares outside India. I sold the shares when I am in France. Do I have to pay taxes for the sale of share of a foreign company? This shareholder is a non-resident, non-citizen. I have no connection with India. I have no connection with India. I am a pure non-resident, pure non-citizen. I sold some shares of a foreign company. Do I have to pay taxes for this transaction? No. Why? It is not accrued in India, not received in India. Very simple. I have no connection with India. Yes or no? Yes or no? Normally it is like this. I don't have to pay any taxes in India because that gain on account of transfer of the shares is not accrued in India, not first received in India. But what department say? If this French company is deriving its value from assets located in India, deriving its value from an assets located in India, then it's altogether different story. If the French company, if it's deriving its value from assets located in India, then the shares of this French company shall be deemed to be an asset located in India. Are you with me? If this French company is deriving its value from assets located in India, then the shares of this company shall be, the shares of this company shall be deemed to be asset located in India. Are you all with me? Now, this is what they are saying. Now, the point is, what do you mean by value deriving from assets located in India? For that, there are two criteria. Okay. So, what they are saying, two criteria are there. Value from assets located in India, we have to satisfy two criteria. Number one, the value of assets. Value of assets located in India should be how much? 10 crore rupees. The value of assets which is located in India for this deeming fiction to come into picture. And how much is the value, friends? It should be 10 crores. The value should be minimum 10 crore. We can say 10 crore or more. Plus, not yet over. One more condition is there. Majority of assets of this French company should be in India. Should be in India. What do you mean by this? Simple example. Say this is the balance sheet of this French company. This is the balance sheet of this French company. Say the French company asset in India. Assets in India is say 20 crore. And the assets in France, say asset in France is 30 crore. Now you tell me total it is 50 crore. You tell me whether this deeming fiction will come into the picture. Answer is no. This deeming fiction will not come. Why? Their total value of asset is 50. Out of that, majority assets are located in France only. Then this fiction will not come into picture. Say instead of this 30, say it is 10 crore. Then what will happen? Then you tell me what will happen. Majority of this French company assets are located in India. Plus the value of the asset located in India is how much? More than 10 crore. If both the conditions are satisfying, then only this deeming fiction will come into picture. Both the value of assets have to be more than 10 crore, 10 crore or more. Plus the majority of the assets of that particular foreign company have to be located in India. So majority of the assets are in India and its value is 10 crore or more. Then only this deeming fiction will come into picture. One more example I can give. Say asset in India is 2 crore, asset in France is 1 crore. Altogether the value is 3 crore. Then you tell me this deeming fiction will come into the picture? No. Why no? Even though the majority of assets is in India, its value is less than 10 crore. So this deeming fiction will not come into picture. That's why I have written a plus over here. Are you all here? So you have to understand there is the separator is and. Both have to be satisfied for this deeming fiction to come into picture. Are you with me? Now there is another thing. So all the relevant theory in relation to this I will explain by making use of the same example. Say listen, we will stick on to the same. Say 20 crore and 10 crore, altogether 30 crore. Say this is the point. Now listen friends, listen. So normally say we will create an example here also. So the Mr. Shareholder purchased the shares in 2020-21 for say 50 lakhs and he sold these shares in the year 2023-24 in the year 2023-24 say for 80 lakhs. Are you with me? So he is selling the shares on say 15th December 2023. He sold the shares on 15th December 2023 for what value? 80 lakhs. Now as you all know, when you check the value derivation, he sold the shares of a French company. But this French company, the value of asset in India is 20 crore and it is the majority assets are also in India. So what is the deeming fiction? The shares of this French company shall be deemed to be asset located in India. And hence what is the conclusion? What will happen? This shareholder who sold the shares for 80 lakhs have to pay taxes in India. That is the ultimate conclusion. Yes or no? Now listen, when you compute the capital gain, how much is the full value consideration? That is 80 lakhs. Full value consideration is how much friends? 80 lakhs. How much is the cost of acquisition? 50 lakhs. Can you tell me how much is the capital gain? 30 lakhs. The total capital gain shall be 30 lakhs. As you all know, what the deeming fiction says is shares of this foreign company shall be deemed to be asset located in India. And hence what will happen according to the theory? Entire 30 lakhs shall be an income deemed to be authorized in India. But it is not like that. What department say is your entire value of asset is not located in India. Only 20 out of 30 is located in India. Yes or no? Your entire value of asset is not located in India. Only 20 out of 30 is in India. So when you compute the capital gain, make the proportion. The taxable capital gain shall be this 20 out of 30. And how much it will be? 20 lakhs. You have to pay taxes only for this 20 lakhs, not for the entire value, because your entire assets are not located in India. What if the 30 out of 30 is located in India? Then the entire 30 you have to pay taxes in India. It is as simple as that. Are you with me? Are you with me? So based on this, let's finish off that particular theory. Now listen, one more thing. Now you tell me, when is the date of valuation? The date of valuation is normally the what? Say, listen, I told you this is the balance sheet. Yes or no? Now what should be the date of the balance sheet? Normally what department say, the date of balance sheet should be the last balance sheet date. Last balance sheet date means you go to the preceding previous year. The preceding previous year will be 2022-23, because according to the example, the year when I sold the shares is in 23-24. So the preceding previous year will be 22-23. Normally the balance sheet date should be 31st March 23. You have to take the balance sheet value as on 31st March 2023 normally. Are you with me? But your sales happened in which day? 15th December 2023. Your sales happened on 15th December 2023. But don't worry, you go take the balance sheet of the last day of the preceding PY. Are you with me? But one more thing they are saying. Say there is an increase in assets. So your last balance sheet date is on 31st March 23 and your sale date is on 15th December 23. Say there is an increase in assets, and the percentage of increase is 15% or more. Compared to the last balance sheet date and the transfer date, say there is an increase in the value of assets, and how much is the increase? 15% or more. If there is an increase in the assets and the percentage is 15% or more, then you have to take the balance sheet as on the date of sale. So I'll go to the theory, don't worry. So what they are saying is how to determine what is the specified date. So you always have to consider the value as on specified date. And what is the specified date? Date ends with the last day of accounting year preceding the date of transfer should be considered. That simply means normally if the date of transfer is 15th December 23, then what should be the balance sheet date? You tell me, what is the balance sheet date? Accounting year preceding the date of transfer should be considered. Accounting year preceding the date of transfer means 22-23, because the date of transfer happened in 23-24. So accounting year preceding the date of transfer will be 22-23. You take the last day balance sheet. Last day balance sheet means 31st March 23. Are you with me? Normally it should be the 31st March 2023's balance sheet. But the specified date shall be the valuation date. In some circumstance, you have to create the balance sheet on 15th December 2023 itself. You have to prepare a balance sheet for 15th December 2023 in certain circumstance. What is the circumstance? In case where the book value of the assets of the company or entity on the date of transfer exceeds by at least 15% of the book value of the asset as on the last balance sheet date preceding the date of transfer. Simply means you go take the balance sheet as on 31st March 2023. Say the book value of assets was 100 crore. Okay. And on 15th December 2023, the company purchased some assets also. They had some increase in the assets and the book value become 120 crores. The book value become how much? 120 crores. Now you can see there is an increase in the value of assets. And how much is the increase? 20%. Yes or no? So there is a 20% increase in the value of assets compared to the last accounting year's date and the transfer date. In such case, you prepare a balance sheet on 15th December 23 itself. Based on that balance sheet, you determine the value. That's what the department says. You have to check whether it is 10 crore as well as whether majority value of assets. So, depends upon the increase in the value of assets. If there is no increase or there is increase less than 50%, don't worry, you take the last day as well the preceding balance sheet. In all other cases, you have to draft a balance sheet as on the transfer date itself. Are you with me? Are you with me? Great. Now, there are 2-3 points are there. Now, listen. Say for example, in the same example, Mr. Shareholder, okay, he is having only 2% shares in the company. He is only having how much? 2% share in the company. And there is another shareholder, Mr. SH1. He having 98% of the shares in that foreign company. So there are two shareholders in the company. Number 1, SH. Number 2, SH1. So we will call SH1 and SH2. Okay. SH1 is there, and how much is the percentage of his holding? 2%. And how much is the percentage of holding of SH2? 98%. Both say SH1 is transferring his shares. SH1 is transferring his shares. And we all know that this foreign company is deriving its value from assets located in India. And what is the conclusion? The foreign company's shares shall be deemed to be an asset located in India. That is the conclusion. Yes or no? Now listen. Say SH1 is transferring his shares. So, according to the theory, SH1's capital gain is also taxable in India. Yes or no? Why? Normally, that asset is deemed to be an asset located in India. If that asset is deemed to be an asset located in India, then whenever you are selling that shares, you have to pay taxes in India. It is as simple as that. But department say, don't worry. You are not transferring the controlling interest in the company. You are not transferring what? Controlling interest in company. You only have 2%. If you are not transferring the controlling interest also, this deeming fiction not applicable. If you are not transferring the controlling interest in that particular foreign company, this deeming fiction not applicable. Now you tell me, what if SH2 sells shares? If SH2 is selling his shares, then 98% shareholding is getting transferred. Then yes, definitely you have to stick on to that particular deeming fiction. Now friends, listen. Why there is this clause? I will tell you, then you will understand the entire logic. Okay, listen. So I am a person having some assets in India. Okay. I'm a person having some assets in India. Imagine, I'm a non-resident. Non-resident plus non-citizen. Okay, so listen. So I am a non-resident plus non-citizen. I have no connection with India. But the only point is I have some assets in India. I am selling these assets. You tell me, what is the taxability? I have to pay taxes in India. Why? Because the asset is located in India. If I am selling these assets, definitely I have to pay taxes in India. Are you with me? But I thought of another idea. Instead of directly owning these assets, I incorporated a foreign company. And I am the major shareholder of this foreign company. Now this foreign company is owning these assets. Now I want to sell these assets. Instead of directly selling these assets, I can sell the shares of this foreign company. Instead of directly selling these assets, say I am selling the shares of this foreign company. So there is another person, this is the buyer, and I am selling the shares of this foreign company to the buyer. Okay, now you tell me, Mr. NR, this black NR have transferred the shares of a foreign company. But ultimately, there is an indirect transfer of assets in India. Because the foreign company is the owner of the assets in India. When the foreign company's shares are getting sold, the ownership changes. Ultimately, the ownership of the Indian assets is also getting changed. So this is a tax evasion mechanism. The non-residents, instead of directly owning an asset in India, they will incorporate a company over there. And they will make use of that foreign company to own the assets in India. Then they will sell the shares of that particular foreign company to avoid taxes in India. Now what department say? If that foreign company is deriving its value from assets located in India, all the shares of that foreign company shall be deemed to be assets located in India. And you are transferring that controlling interest then you have to pay taxes in India. If you are not transferring some controlling interest, then we cannot say that the ownership of this assets is transferred. That's why they are bringing out this controlling interest point over there. Are you with me? Are you all here? Now one more thing, listen. So according to the theory, all the assets of this foreign company shall be assets located in India. Now you tell me, what if I am getting some dividend from this company? What if the shareholder is getting some dividend from this particular company? That is also taxable. Why? Because according to the theory, the asset shall be deemed to be asset located in India. If you are getting some income from assets located in India, that income normally shall be taxable in India. Yes or no? But department say, don't worry. We have no plans to tax that particular dividend. Why? We only want to tax those controlling interest transfers. All the dividend income and small share sales and all is irrelevant for us. Are you with me? So if you are getting some dividend from that particular share, that dividend is also not taxable in India. That is also outside the purview of taxability. Are you with me? Now we will go through the theory again for a better understanding. Now you have to respond and answer along with me. I know it is a comparatively complicated concept, so we will revise that entire theory again. So listen, what is the first thing that you should know? Capital asset being shares of a foreign company shall be deemed to be asset in India. In certain circumstances, you are a foreign company and the shares of that particular foreign company shall be deemed to be assets located in India. What is the circumstance? Number one, if such share or interest derives directly or indirectly its value substantially from assets located in India. If the foreign company is deriving its value from assets located in India, then all the shares of that particular foreign company shall be deemed to be an asset located in India. Now, what is the substantial value derivation? For that, the value of the assets situated in India should exceed 10 crore. It is not 10 crore or more, okay? That was actually a mistake. It should be more than 10 crore. Exact 10 crore is also not a problem. Exact 10 crore is also not a problem. It should exceed 10 crore. That's what they are saying. So it should be more than 10 CR and represent 50% of the value of all the assets owned by the company or entity. That simply means the foreign companies majority assets have to locate in India, plus the foreign companies value of asset located in India should be more than 10 crore. If both the conditions are satisfied, then that foreign company shares shall be deemed to be an asset located in India. I hope this much is clear. Not yet all. How to determine the value? How do you determine the value? You take the fair market value as on the specified date. That means the valuation date of such asset without reduction of liability, if any, in respect of assets determined in prescribed manner. Don't deduct any liability. You only have to check the fair market value of the total assets. Irrespective of liability, don't dilute liability, ignore liability. It totally depends upon the fair market value of asset located in India. Okay, now point number 3. What is the specified date? That means what should be the balance sheet date? For determining the value of the assets, you should require a balance sheet. Yes or no? What is the balance sheet date? You tell me normally what is the balance sheet date? Preceding accounting year's last day's balance sheet should be the relevant balance sheet. Yes or no? But if there is an increase in assets compared to the preceding last day and the transfer day, if there is an increase in the assets and the percentage of increase is more than 15%, then you have to prepare a balance sheet as on the date of transfer. Based on that only you are supposed to value. That's what we are about to say. The date ends with the last day of the accounting year preceding the date of transfer should be considered. Specified date shall be the valuation date if in case where the book value of the assets of the company or entity or the transfer exceeds at least 15% of the value of the assets as on the last balance sheet date preceding the date of transfer. This is what they are saying. Now, not yet over. There is an exclusion. What is an exclusion from the above deeming fiction? Explanation 7 to section 9 provides that no income shall be deemed to accrue or rise to a non-resident from transfer outside India if any share of or interest in foreign company or a foreign entity in the following circumstances. So, in the following circumstances, deeming fiction will not come into picture. Which all are the following circumstances? Point number 1. If such transferor non-residents at the time in 12 months preceding the date of transfer does not have more than 5% of total voting power or share capital or interest of the foreign company. If the amount of share that you are transferring is less than 5% of the total voting power, that means the bulk of shares that you are transferring is less than 5%, then no deeming fiction. Or does not hold the right of management or control in relation to the company or entity. You don't have any controlling interest in the company. Then also you don't have to worry about this deeming fiction. The two circumstances is outside the purview of this deeming fiction. The amount of shares that you transfer is less than or equal to 5% of the total voting right. Or you are not transferring, it is more than 5%, but you are not transferring controlling interest. Both the cases, you are outside the purview of this deeming fiction. Then in both the cases, NR, don't worry about paying taxes in India. Are you with me? Now, note number 1, where all the assets of the company are not located in India, income of the transferor NR shall be taxable in India proportionately. Hope you remember 20 out of 30, that thing. Now, note number 2, it says the dividend declared and paid by the foreign company outside India in respect of shares which derive their value substantially from asset located in India would not be deemed to be income accruing or arising in India. That means the shareholder is getting some dividend out on account of his investment. That dividend will never become a deeming income in India. And note number 3, assets held by non-resident directly or indirectly in category 1 foreign portfolio investor shall not be deemed to be situated in India even if deriving its value from asset located in India. If you are a foreign portfolio investor, you came to India, invested after by getting a category 1 FPI certificate. What is category 1 FPI certificate? Foreign portfolio investor. Those foreign institutions which comes to India for growing their portfolio. If you are in that category and you have a category 1 FPI certificate from SEBI, you are also not covered under this deeming fiction. So these are the 3 notes associated in relation to this particular concept. I hope it is clear for you. Now let's go back to the original chart. We have discussed only the first part of the chart, and what is that? Any business connection in India, any property or asset or source of income in India, or transfer of capital asset situated in India. Now we will move on to the second box in that particular chart. Friends, tell me what is the second box. Can you read the second box? Salary earned for services rendered in India. You are earning some salary outside India, but the place of provision of service is in India. Then all the salary that you are getting outside India shall be deemed to be accrued or arised in India. Simple example. Say during the term of employment I was working in India. Now I got retired. Okay, I am basically US citizen. I came to India and provided 10 years of service in India. Thereafter I retired and then went back to US and I'm getting pension. Now the pension that I got is on account of services that are provided in India during my period of service. That pension shall be deemed to be income accrued or arised in India. Are you with me? So you are getting some salary or you are earning something outside India due to the services provided in India. Definitely taxable in India due to this deeming fiction. It is as simple as that. Moving on to the next one. What is the next one? Salary payable by government to Indian citizen for services rendered outside India. What do you mean by that? This is for our foreign diplomats, our IFS officers who are working outside India. Say for example, India have embassies in Japan. There is Indian embassy in Japan. Our central government will pay salary to the embassy officers in Japan, but they are providing services in Japan. They are residents of Japan. Doesn't matter. What department say? Salary payable by the government to Indian citizen. Those officers will be Indian citizens, but they are not Indian residents. The resident and citizen both are different. Resident means the place where you live. Citizenship means the place where you are identified as a citizen. You are a person residing in Dubai with an Indian Aadhaar card. You will be considered as a Indian non-resident. That means Dubai resident Indian citizen. We call it as NRI, non-resident Indian citizen. Are you with me? So likewise, you are a person who is a citizen of India but providing services outside India for our government, and our government is paying you what? Salary. Then you tell me what will happen. That salary shall be deemed to be accrued or arised in India. So that simply means all the embassy officers who are working in Japan, in Indian embassy, the salary payable by the central government shall be deemed to be accrued or arised in India. It is as simple as that. Now friends, you tell me, salary means basic, DA, commission, allowances, perquisites, etc., etc. Yes or no? Normally salary means basic, commission, bonus, DA, perquisite, allowances, etc., etc. But in this case, the allowances and perquisites paid by the government to Indian citizens outside India shall not be taxable. It is exempted under section 10 subsection 7. All the allowances payable by Indian government, all the perquisites given by Indian government for those citizens who are outside India will not be taxable in India because it is fully exempted. What if it is basic salary? Is it taxable? Yes. What if it is bonus? Is it taxable? Yes. What if it is commission? Is it taxable? Yes. Bonus, commission, gratuity, pension, etc., etc., whatever it is, fully taxable. Allowances and perquisites are outside the scope of taxability. That's what the department says. I hope that point is clear. Moving on to the next point, let's understand what is the next point. What is the next point, friends? Dividend paid by Indian company outside India. That simply means you are an Indian company, you conducted an AGM outside India, declared dividend outside India. Doesn't matter, all the dividend declared by an Indian company shall be always deemed to be accrued or arised in India. Don't waste your time and money. You conduct AGM in India only. You go outside, conduct the AGM outside. Then you are saying that we have declared dividend outside India. Who cares? Indian company, irrespective of your declaration of dividend, that dividend shall be always deemed to be accrued or arised in India. Are you with me? All the following four situations we can say the dividend shall be deemed to be accrued or arised in India. So the chart 1 is completely over. But the topic is not yet over because we have one more chart to complete under section 9. So let's understand what exactly is chart number 2. Let's understand and let's go through this chart number 2 for a better clarity over these topics. So again, listen. So listen friends. Okay friends, now we will discuss the second chart. And what is second chart? So listen, we'll read the chart first. Income deemed to accrue or arise in India. So let's understand what is this income deemed to accrue or arise in India. Listen. Say for example, interest or royalty or FTS if payable by a person resident in India. So listen friends, whenever from now onwards, whenever I say interest, what you have to understand it is interest on loan. Interest on loan. Now, what is royalty? What do you mean by royalty, friends? Royalty simply means any payment received for right to use. So, royalty means payment for right to use. Say for example, I am a book author and have completed my book, and a publishing company is making use of the copyright and they are making me a payment, and the payment given by the publishing company for using my copyright can be called as what? Royalty. Alright. So, and finally what is FTS? It simply means fees for technical services. Fees for technical services. Say for example, managerial service, consultancy service, all those skill involved services. If I am getting any fees for that, that will be normally called as what? Fees for technical services. So if I am getting interest on loan or royalty or FTS, and if that is payable by a person resident in India. Simple example I can give. Say for example, there is a NR, say there is a non-resident and there is a resident. Okay, there is a resident and non-resident. This resident took loan. This resident what? Took loan. from non-resident. Now this resident have to pay what? Interest to the non-resident. Yes or no? Interest on loan. So what department say? If the interest is payable by a resident in India, then that interest shall be an income deemed to be accrued or raised in India in the hands of recipient non-resident. So here the non-resident is receiving some interest. Yes or no? Here the non-resident is receiving some interest from a resident. So if the person who pays that interest, if that person is a resident, then this interest shall be deemed to be accrued or raised in India in the hands of NR. It is an income for the NR only. So the deeming fiction says NR is receiving an interest from a resident, then that interest income of NR shall be an income deemed to be accrued or raised in India. Are you all with me? It is as simple as that. Now moving on to the second point. What is the second point? That is royalty. So listen. Say this NR is a book author. NR is a book author and he shared the copyright. He shared the copyright with the resident. Now the resident is supposed to make him a payment and that payment is called as what? Royalty. Now here we can say royalty is payable by a person resident in India. In this case, royalty is payable by a person resident in India and it is received by the NR. And if the person who pays the royalty is a resident, then that royalty shall be an income deemed to be accrued or raised in the hands of recipient NR according to section 9. And one more thing, say this NR has provided some technical services. Technical services. Say some skill involved services or something, and this resident is paying what? Fees. Okay, so here also we can say fees payable by a resident in India, received by a NR. This fees also shall be deemed to be accrued or raised in India. So the point is very simple. Interest, royalty, fees for technical services, if these are payable by a resident, then what is the conclusion? These items shall be deemed to be accrued or raised in India in the hands of a recipient. Who is the recipient? It should be NR. If the recipient is also a resident, then there is no there shouldn't be any deeming fiction, because if the recipient is a resident, then anyways that income will be taxable in India in a sense. It is intended for a non-resident recipient. The section 9 is actually intended for NR recipients. Are you all here? So these are the cases where section 9's second flowchart will come into the picture. Okay, so if interest on loan payable by a resident, or if copyright royalty for the copyright is payable by a resident, or fees for technical services is payable by a resident, this shall be an income deemed to be accrued or raised in the hands of recipient, non-resident. I hope that point is clear. Now not yet over. What they are saying is, now there is an exception to this point. Let's understand what exactly is that exception. Are you all listening? Let's understand what exactly is that exception. So what they are saying is, if the money borrowed or technical services or royalty services are utilized for the purpose of business or profession carried on outside India for making any other source of income outside India. Simply means, say listen, see, this resident took the loan. That resident, he took a loan, or he took the copyright, or he took some technical services. Now we have to utilize that. Without nothing, I simply will never take a loan. Only for the utilizing it for something, I will take a loan. Yes or no? So what department say? If the utilization of this loan or copyright or technical services is outside India, this resident took the loan or took the copyright or took the technical services and he utilized it outside India, either for his business or profession or for any other source of income outside India. So this NR, the resident took the loan or took the copyright or took the technical services for utilizing it outside India. Say for example, his business or profession, or he is making any other income outside India. So utilized it outside India. Then department say this deeming fiction not applicable. So how we can conclude this? It's very simple. If you are a resident and you are paying interest and you took a loan for utilizing it in India, it can be for business or for profession or for making any other source of income in India. In all the three cases, the interest that you are paying shall be deemed to be accrued or arised in India in the hands of recipient, non-resident. Case 2, you took a copyright for utilizing it in India for your business, profession or for making any other source of income. In all these three cases, you are paying the royalty shall be deemed to be an income accrued or arised in India in the hands of recipient. You took a technical service utilized in India for your business or profession or for making any other source of income in India, and you are paying that fees shall be deemed to be income accrued or arised in India in the hands of recipient NR. That also means you are utilizing these items outside India or either for your business or for your profession or for making any other source of income. Then in all the three cases, income shall not be deemed to be accrued or arised in India. It will be outside the purview of section 9. I hope you got my point. Now moving on to the next one, let's understand what exactly is the next point. So listen, see what the next point, what it says is, so if interest or royalty or FTS, if payable by a government, if these three items are payable by government, then you tell me what will be the impact. Always deemed to be accrued or arised in India. That means instead of resident, this loan or this copyright, everything took by government. Government of India, okay, government means obviously government of India. Government took a loan, government took a copyright, government took a technical services. Whether it is utilized in India or outside India, anyways government will utilize it for the benefit of Indians. Indian government will utilize these services for the benefit of Indians, whether it is in India or outside India. Only for the benefit of Indians they will utilize. So they are utilizing it. Then irrespective of the place of utilization, all the interest, all the royalty, all the fees for technical services shall be deemed to be accrued or arised in India. No exceptions, no conditions. If the government is paying interest, government is paying royalty, government is paying fees. In all these three cases, all these three amounts shall be deemed to be accrued or arised in India, irrespective of the place of utilization. I hope you got my point. Now, what is the third case? Interest, royalty, FTS, if payable by a non-resident, that's what they are saying. That simply means, friends, listen, this is a little bit technical, okay? This is a little bit technical. So I want all of you to be attentive and careful here. You have to be a little bit careful, otherwise you will lose the track, okay? So what they are saying is, say an NR took a loan, okay? NR took a loan from another NR. A non-resident took a loan from another non-resident, and this non-resident utilized that loan in India for business or profession. Okay, are you all listening? Yes, sir. A non-resident took a loan from another non-resident, and the person who took the loan, that NR, utilized that particular loan amount in India either for his business or for his profession. Then the interest paid shall be deemed to be accrued or arised in India in the hands of recipient, non-resident. So there are two things. The person who took the loan, in this case is NR, he should utilize it for his business or profession in India. And what if he is utilizing it outside India? Deeming fiction is not there. What if he is utilizing that amount in India for any other source of income? Section 9 not applicable. Section 9 is very clear. If you are taking a loan, you have to utilize that loan amount in India for the purpose of business or profession in India. If you are utilizing it outside India or you are utilizing it for making any other source of income, section 9 not applicable. Are you with me? Yes, is that clear? Not over. We have one more thing. he took a copyright. NR took a copyright. Or he took some technical services. He took some what? Tech services. And its utilization utilized for business or profession or for any other source of income in India. So, in the case of royalty FTS, the NR who took the service have to utilize it for either business or for profession or for making any other source of income, that too in India. Then naming fiction will come into picture. So, there is a slight difference between the loan and the FTS and royalty. If the loan is taken by an NR, that NR have to utilize that loan amount in India for his business or profession. Then only section 9 will come into picture. If royalty, copyright or technical services is taken by an NR, he can utilize it for his business or profession or for generating any other source of income in India. All the cases naming fiction will come into the picture. Are you all with me? Now let's move on to the theory, to the chart. What it says is condition. If money borrowed and utilized for the purpose of business or profession carried on in India. That means money borrowed have to be utilized in India for his business or profession. And how about the other one? If technical services or royalty services are utilized for the purpose of business or profession carried on in India or for making income from any source in India. In the case of tech services, either you have to utilize it in India, either for your business, profession or for making any other source of income. All the cases naming fiction will come into picture. I hope you got my point. Are you all with me? Alright friends, so we were discussing about section 9. I hope this much is clear for you. Now it's time for us to solve some questions, some past exam questions. We are only dealing with past exam questions, okay. So let's solve some past exam question. Yeah, so friends, let's solve a question that has been tested in May 2023 for 6 marks. It's actually a theory question. So let me cross off the answer. So please don't look at the answer, just go through this question and give me the answer, okay. Just go through this question, understand the situation and give me the answer. It's actually a pure theory question, question 25. Just go through it and give me the answer. So let's read the question. Messrs ABC Incorporate, a company incorporated in Korea, entered into an agreement with XYZ Limited, an Indian company, for providing assistance to later in setting up a power plant in Gujarat. So ABC Incorporate is in Korea. So we will, if you are not getting a grip of our question, then what do you need to do? Skip the question and read the next question. Huh? No. You have to draw a chart based on the facts and figures of that particular question. Okay. So we will read that question together. Yes. What is that? They are saying ABC Incorporate in Korea. They have an agreement with XYZ Limited in India. So there are two companies, ABC Incorporate in Korea and XYZ Limited, which is in India. They have an agreement. Okay, both of them have an agreement. They have an agreement. That's what they are saying. So for providing assistance to the later in setting up a power plant in Gujarat. So later means they are providing some assistance to XYZ Limited, which is in Gujarat. The scope of work includes offshore services in nature of drawing and design of electrical and networking work. So what they are saying is they want to install, the ABC Limited is helping XYZ Limited to install some machines in India. Okay. This work have two parts. Number one, offshore part, like designing, drawing and all. What do you mean by offshore? For doing that offshore part, ABC Incorporated is not supposed to come to India. Offshore means it's outside India. They might be drawing some drawings, like electrical drawings or something, and designing something in Korea itself. Are you with me? Then it has a second part also. What is the second part? Onshore services. Onshore means in India. They came to India. onshore means here, offshore outside here. Okay. So onshore services in respect of installation of such machinery. So they have to install that machine in India. For that they have to come to India. So they will design it when they are outside India. Thereafter they will come with the design and install it in India. So the consideration for the aforesaid scope of work was agreed to be 3 crore for the offshore services. For offshore it is 3 crore and 2 crore for onshore services, and for this it is 2 crore. Consideration was discharged as under. 3 crore in respect of offshore services was paid in ABC's bank account in Korea on 1st July 2023. So XYZ paid this 3 crore directly to that Korean bank account. Then the second set, they instead of paying money, they given 6% debenture. So this settlement happened in 6% debenture. It is issued in 1st September 23 in consideration of for onshore services. So if they are giving debenture, then they will get another income. There is an accretion, that is interest on debenture. Yes or no? The relevant PY in the question is 23, 24. That's why the AY is 24, 25. So the PY is 23, 24. And there will be 6 months interest. And how much will be that interest? 6% into 2 crore into 6 months divided by 12. Can you help me with the math? How much is 6% on 2 crore for 6 months? Is it 7 months? Yeah, 1st September. Yes. I'm sorry, it's 7 months. From 1st September onwards, they got it. So it's 7 months. Can you tell me how much is 7 months interest? 7 lakhs. So it will be 7 lakh. Now you tell me, for the purpose, discuss the tax implication in India in respect of the above transaction in the hands of ABC Incorporate under the provisions of the Act for assessment year 24-25. For the purpose of your answer, you may assume that activities of ABC Incorporate do not constitute any business connection in India. Ignore the provisions of tax treaty and DTAA. So very simple, they are saying what is the taxability of that 3 crore, 2 crore and that 7 months interest. First of all, let's identify the service. What is the type of service? Fees for technical services, because it involves some drawing, some kind of designing. It's a technical service. That's why they are coming from Korea and installing it. A common layman with a minimal knowledge cannot install it. That's why this XYZ Limited is calling ABC Incorporate from Korea. Yes or no? So the entire 3 plus 2 shall be fully taxable in India. Why? Because it is provided in India and provided to a resident. The payment is given by a resident. So that 3 crore taxable according to section 9. How about this 2 crore taxable according to section 9? How about this 7 lakh taxable according to section 9? Why? Because it is an interest income that the Korean company is about to derive in the year end from assets located in India. So 3 plus 2 plus 0.7. That means 5 crore 7 lakh. Entire amount shall be fully taxable in India according to section 9. Have you understood? So this is the way they are testing and you are getting 6 marks for this. Okay, it's actually lottery. You have to write a glimpse of section 9 as well, because basically it's a theory question. Okay, you have to write the theory involved as well. You have to identify it as a FTS. Then for the 3 points, 3 marks. Sorry, for 3 point into 2, that is 6 marks, 3 into 2. Are you with me? This is how they are testing all this in examination. I hope it is clear for you. Great. Now friends, we will jump into the next chapter, that is called as NR taxation. I am jumping into NR taxation and completing the important concepts under NR taxation. So let's see which all are the important things that we have to study under non-resident taxation. So the first section that I want to cover under NR taxation is, so that is section 44DA, special provision for computing income by way of royalty, FTS, etc. in the case of non-resident. This is the first section that I want to cover. Okay, we will be covering 44DA, thereafter 115A, B, C, D, E, F, G, H, sorry, 115 C, D, E, F, G, H, I, thereafter 115A, AC, AD, AB. These are the topics that I am planning to cover. Along with this, I will be covering 44C as well. So these are the important topics in my understanding in this NR taxation chapter. So without wasting time, let's start with section 44DA, special provision for computing income by way of royalty, etc. in the case of non-resident. So let's understand. First of all, listen friends, this is not a section for taxing an income. This is not a flat rate of taxation. This is not any presumptive provision and all. What department say is, if you are an NR, satisfy certain conditions, then all the royalty income plus FTS, that is fees for technical services, shall be taxable after following these two conditions. Okay, so very simple friends, if you are an eligible person, if you are a person who satisfies certain conditions, earning some royalty or FTS, while computing that income, while computing that royalty or FTS, you have to follow these two conditions. That's it. It's just like an explanation. Are you with me? This section does not provide for any flat rate of taxes. This section is not a charging section and all. This is a section to help an NR to compute their income that is under royalty or FTS bracket. If you are computing your taxable income under royalty or FTS, you have to follow 44DA if you are satisfying the conditions mentioned here under. So let's understand this section in a very detailed manner. So let's read the first point. This provision is for taxing royalty or FTS in the hands of eligible assessee. If you are an eligible assessee, then this provision will help you while computing royalty and FTS income. So let's understand who is eligible assessee. First of all, let's understand who exactly is the eligible assessee. So number one, a non-resident having made an agreement with an Indian company or government after 31st March 2003. The NR should have a permanent establishment or a fixed place of profession in India. PE means permanent establishment. Permanent establishment. For the time being, permanent establishment simply means a branch, a sales outlet, factory, plantation, etc. Okay. Permanent establishment simply means a branch, sales outlet, factory of an NR which is in India. Now, plus the royalty or FTS received should be connected with such PE. So, I will draft an example for a better understanding of these 3 points. Listen, say for example friends, listen, say you are a non-resident, say you are a non-resident, you have an agreement with Indian government, with the central government in India. You have an agreement with central government, with CG. Okay, and you have a branch in India. Branch in India. Due to this agreement, this branch is providing some tech services. This branch is providing some tech services to central government. And central government is paying what? FTS. Central government is paying what friends? Fees for technical services. Let's understand whether this FTS in the hands of NR is taxable under 44DA or not. For that, first you need to check whether this NR is an eligible NR. What are the qualities of an eligible NR? Number one, NR should have an agreement with either Indian company or government, and the date of agreement is actually important here. And when is the date of agreement? 31st March 2003. The date of agreement should be on or after. On, it's not on, it should be after 31st March 2003. Now let me ask you this question. Say I have signed an agreement today. I have signed an agreement today. First condition is satisfied. Why? Because today's date is after 31st March 2003, not 23, 2003. So first condition is done. What is the second condition? The non-resident should have a permanent establishment or a place of fixed profession in India. Now let's check whether he has a permanent establishment. You tell me whether he has a permanent establishment. Yes, branch in India can be called as a permanent establishment in India. So that is also satisfied. Now what is the third condition? the royalty or FTS received should be connected with such PE. That means the branch have to provide the service. Due to that service, the branch is earning some income. According to the example, even though the agreement is signed directly by the head office, parent, services are provided by the branch. So that FTS is connected with PE in India. Connected with PE in India. Now, the branch, while computing the royalty income, have to follow section 44DA for the computation of royalty income. Okay, if all the three conditions are satisfied, branch while computing the taxable royalty component have to follow the conditions mentioned under 44DA. Now let's understand what are the conditions under 44DA. So, royalty and FTS under this section is taxed at normal rate under the Act. No flat rate prescribed. There is no flat rate provided in this particular section. It is not a flat rate section. But now you will ask me what is the purpose of this section. Okay. However, while computing income, following expenses are not allowed as deduction. So friends, what is the objective of 44DA? You have royalty or FTS. Then while computing this, the following expenses are not allowed as deduction. If you are a person who is a non-resident earning royalty or FTS and you are satisfying the conditions under 44DA while computing the income, royalty, FTS, you are not supposed to claim the following expenditures as a deduction. And what all are the restrictions? So 44DA provides two restrictions. That's it. Are you all listening? Section 44DA is a section which provides restrictions while computing expenditures from your royalty or FTS income. Let's understand which all are the restrictions. Number one, what is the first restriction? What they are saying is any expenditure which is not wholly and exclusively incurred for the business of such permanent establishment in India. That simply means, as you all know, this NR parent will incur a lot of overheads. This NR parent will incur a lot of overheads. According to the costing standards, this overhead will be bifurcated to each income generating units on a reasonable basis. Yes or no? You cannot charge any of those overheads which is bifurcated to the Indian branch. Only those expenses which are exclusively incurred by the income Indian branch to generate the income can only be allowed as a deduction. You cannot charge any of the overheads which is bifurcated from the head office while computing the royalty or FTS income. Are you with me? That is the first restriction. Only those expenses which are exclusively incurred for the branch to earn that royalty income is allowed as a deduction. All other expenses you have to ignore. Are you with me? However, while computing income, the following expenses are not allowed. It's starting in a negative manner. Okay, which all are the items that are not allowed? Any expenditure which is not wholly and exclusively incurred, okay, for the business of such PE. So only that simply means only those expenses which are exclusively incurred is allowed as a deduction. And what is the second restriction? Amount paid by the PE to its head office or to any of its other offices otherwise than towards the reimbursement of actual expenses. Simply means, say for example, this branch is paying some service fee to this parent. This branch is paying what? Service fees to this parent. As you all know, both the branch and parent is only one and only the same. Branch means an extended operation of a foreign company. But for the purpose of taxes, only those profit earned by the branch will be taxable in India. Profit earned by the head office is not taxable in India. So from the eyes of income tax law, say I am income tax law. In my eyes, branch is a person, head office is another person. While computing the expenditures of branch, all the payments given by the branch to the head office is fully disallowed. Why? Otherwise, to bring down the taxable profit in India, I can simply create some expenses. Service charge to the head office, support charge to the head office, technical charge to the head office. If I charge all these expenses, profit of the branch will go down. Profit of the head office will go up. As a group, I am not getting anything, not losing anything. But I can reduce my profits in India. So what department say? All the payments given by the branch to the head office shall be fully disallowed. If it is a reimbursement of actual expenses, then it is allowed. What do you mean by reimbursement of actual expense? Say for example, branch does not have money to pay the salary. So head office initially paid the salary. Then branch is reimbursing that salary to the head office. That is deductible. Are you all with me? Say there was some staff in the branch. Branch does not have money to pay the salary to the support team in the branch. So head office initially paid the salary. Now branch is reimbursing that amount. That is deductible. Fine. All other payments apart from the reimbursements shall be fully disallowed. Are you all here? So these two are the restrictions under 44DA. Now friends, listen. Sum of 44DA. Very simple. We can finish the 44DA in 2 minutes. If you are an NR having royalty income or FTS income and you are having a PE in India, you have an agreement with the central government or an Indian company and the date of agreement should be after 31st March 2003. Plus you are providing services through your PE in India. You are earning either royalty or FTS. You deduct all the exclusive expenditures of the branch. Don't deduct any common overhead expenditure that is bifurcated from the parent. Then you can deduct all the expenditures of the branch. Don't deduct any payment that given by the branch to the head office. If that payment is a reimbursement of actual expenditure, you can deduct. This is it. Then your taxability will be according to the normal rate. You are a branch of a foreign company, so the normal slab rate will be 40%. If there is some other flat rates provided in the act, you follow that flat rate. That's it. Are you all with me? No. Not yet over. In examination, they will twist the questions. They will twist and turn the questions in different manner. So this is a chart that will actually help you to crack an adjustment related to this. Because in examination, they may ask 44DA or they may twist the question in different manners. So this chart will actually help you to crack the complicated adjustments in your examination. So listen friends, study this as certain steps. Okay. First of all, if there is some royalty and FTS income and the assessee is an NR exam, then the first thing that you have to do as a student is check the possibility of 44DA. If there is in exam, if the assessee is an NR and he is having royalty or FTS, then you check whether it is taxable under 44DA. For that, 3 conditions: agreement, date, permanent establishment, and services should be connected with PE. If any of these are missing, 44DA not applicable. Then what to do? Then there is another section called 115A. If not covered under 44DA, and there should be an agreement entered into between assessee and the Indian company or with the central government. Say for example, NR does not have a PE in India, but they have an agreement. They have an agreement with the Indian company. They don't have a permanent establishment in India. 44DA not applicable. Then it will be taxable under 115A. It will be taxable under what? Which section? 115A. And what's the speciality? It's a flat rate section. The rate of tax will be 20% without claiming any expenditure. That means gross income have to be taxed at 20% without any plus cess. Okay, cess and surcharge will come. Okay, I'm talking about the flat rate, basic tax rate. The basic tax rate will be at 20%. You are not supposed to deduct any expenditure from this. Now you tell me, income is not taxable under 44DA. There is no agreement at all. Okay, there is no PE, no agreement. Then 44DA will not come. 115A also will not come. Then what to do? Then consider it as a normal income and claim all the expenses as a deduction, and you pay taxes according to the slab rate. Are you with me? If 44DA is not coming, 115A is also not coming, then you consider it as a normal income and pay the taxes at the applicable slab rate. Are you all here? This is how you have to deal with the question in examination if they are mixing up 115A, 44DA and the other provisions together. Are you all here? Great. So friends, I want all of you to go through this question number 23. This is December 2021, which is an old syllabus. Okay, 6 marks. They have tested it for 6 marks. So I want all of you to go through this question and give me the answer. It's a fantastic question that mixes up 44DA, 115A brilliantly. So go through this and give me the answer. Alright friends, so let's solve the question together. What are they saying? So Vista Limited, a British company, entered into an agreement with Yamuna Limited and Godavari Limited, Indian companies, in the year 2012 to provide technical services to them to be utilized for the business carried on by them in India. So they have Vista Limited being a British company having some agreement with different Indian companies, and the agreements are signed in the year 2012. Now the agreements are approved by the central government. Following particulars are provided by the Vista Limited in respect of previous year 23-24. So FTS income, expenses, FTS services provided, received from Godavari, its expenses, other expenses, general expenses, amount paid by PE to head office, amount paid by PE to head office again. Examine the taxability of income received by Vista Limited on the following assumptions. Point number 1, Vista Limited does not have permanent establishment in India. If Vista Limited does not have permanent establishment in India, always think from 44 DA first. DA not applicable. Why? Agreement is there, it is signed after 2003 and all, but there is no PE. So 44 DA ruled out. Next is 115 A. Agreement is there? Yes. Either with the government or with an Indian company approved by government. So we can say that it will be taxable under 115 A in case number 1. So will be under section 115 A, and what is the rate? 20%. Can you claim this expense as a deduction? No. Here also under section 115 A at the rate 20%. Can you claim the expenses as a deduction? No. Everything is gone. So 250 lakh and 200 lakhs will be subjected to 20% rate of basic tax. Are you with me? Are you with me? And can you tell me how much is that 20% of 250 and 200? Come again? 19. So 90 lakhs, 90 lakh plus it will be subjected to what? Cess. It will be subjected to surcharge and cess. And how much is the surcharge? Being a foreign company, this is actually a foreign company, right? The surcharge will be at 2%. The surcharge will be at what percent? 2%. Since the total income is how much? How much is the total income? 650 lakh. That is 6 crore 50 lakh. Sorry, 4 crore 50 lakh. Yes or no? 250 plus 200, it will be 4 crore 50 lakh or 4.50 crore. If the total income is more than 1 CR, then surcharge will be 2%. If the total income is more than 10 CR, surcharge will be 5% for a foreign company. So here 2% surcharge plus 4% cess. So how much is 90 lakh into 2% surcharge? How much is 90 lakh into 2% surcharge? 1.8. So 1.80. How much is 91.80 into 4% cess? 3.672. So can you tell me how much is the total tax liability? 91.80 plus 3.672. That will be 95.472 will be the effective rate of tax. I hope that point is clear for you. And moving on with the next point. What is the next point? That is, Vista Limited has a PE in India and the contracts or agreements are effectively connected with such PE. Then it's altogether a different answer. So if there is PE and everything is connected with PE, then taxability will be under section 44 DA. So we will write the items. So first one, FTS, that is 250 lakhs. And there are expenses. Can you deduct the expenses? Yes. First expense 30 lakh you can deduct. And there is one more income 200 lakh. And the related expense is 21 lakh that you can deduct. Now, how much is the net income after the expenses? 250 minus 30 will be 220 and the other one will be 399 lakh will be the total income. Then there are certain common expenses. General expenditure not wholly and exclusively incurred for such PE. What to do? General expense. General expense, can you claim? No. Then amount paid by PE to head office not being nature of reimbursement of actual expense. PE to HO, ignore, not deductible. Amount paid by PE to HO being nature of reimbursement of actual expense. Can you deduct? Yes. And how much will be the net taxable income? 384 lakh. Now you tell me 44 DA, what is the basic tax? 40% being foreign company, and 3 crore 84 surcharge 2% and cess 4%. And can you help me with the effective rate of tax? In second scenario, how much will be the effective rate of tax in scenario number 2? So effective rate of tax will be 42.432 lakhs. Basic tax 40%. On the basic tax you apply 2% surcharge. On basic tax and surcharge you apply 4% cess. This is how you have to apply. Okay. So we'll do one thing, don't worry. Yeah, we'll do step by step, okay. How much is 40% on 384? 153.6%. How much is, not percent, sorry, 153.6 lakhs. How much is 153.6 into 2%? 3.072. How much is 153.6 plus 3.072 into 4%? 6.26688. How much is the total of these three? 1.153.6 plus 3.072 plus 6.26688. 162.9389. We can write 89. Okay, as a round off. Is that clear? 162.9389. That's it. Alright friends, so we have completed 44 DA. Now we have to complete the other things in NR taxation, the other important topics in NR taxation. I think this topic they have tested twice, one as an MCQ or one as a small one word or MCQ. I don't know what exactly is the question because they are not giving the MCQ questions. I heard once tested in MCQ and once there is a full-fledged problem. That problem we will solve. Okay. So let's understand what is this 44C. Before moving on to 44C, let me give you a small example to make it more clear, to give you a more clarity. We will make use of an example. Say for example, say I am a group called Tata Group. Okay, so instead of Tata Group, I will use some other name. Say KK Group. Say there is a company called KK Group of companies and they have one entity in India and the other entity in a tax haven. Okay, one in India and the other one in tax haven. What is tax haven? A place where the rate of taxes is either zero or there is no tax at all. Okay, normally these kinds of jurisdictions are called as what? Tax havens. Now listen, this particular company have incurred certain general overheads. General overheads like common administrative expense or an advertisement expense, etc. A common advertisement expense or a general overhead expense. They will bifurcate more expenditure to their Indian branch and they will bifurcate less expenditure only to a tax haven. Why? Because anyways they have incurred their expenditure. If they bifurcate more expenditure to Indian branch, then they can save more taxes in India. The other one is a tax haven. So whether you have bifurcated in a tax haven or not, that doesn't make any difference. So there is always a tendency for a multinational group to charge more expenses, especially in their Indian entities. So what department say? If you are a branch in India, then there is a ceiling limit for the deduction that you can claim for the head office expenditure. So if you are planning to claim head office expenditure as a deduction, then we are putting a ceiling limit under 44C. We are putting what? Ceiling limit under section 44C. That's what we are about to discuss right now. So 44C is all about ceiling limit for head office expenditure. So let's understand section 44C. What they are saying is deduction of head office expenditure in the case of non-resident. If you are a non-resident and there is some head office expenditure you are about to claim as a deduction, then we are putting certain ceiling limits for that particular deduction. Let's understand what exactly is that ceiling limit. So point number one, head office expenditure means executive and general administrative expenditure incurred outside India. Now before moving on, let's understand what exactly is the ceiling limit. We will complete the ceiling limit and we will discuss the other things. So what is the ceiling limit? This part is all about that ceiling limit. What is that? Deduction shall be as follows. The deduction can be claimed only in the following manner. Number one, either 5% of your adjusted total income or actual head office expenditure, whichever is lower. Either you take your actual head office expenditure or you take 5% of the adjusted total income, whichever is lower. Now the question that you will ask is, sir, what exactly is this adjusted total income? Now let's understand what exactly is this adjusted total income. So for computing adjusted total income, there is a formula given. What is the formula for computing adjusted total income? You take your total income, and if you have claimed any of these items from the total income, then you add back. From your normal total income, you add back this 1, 2, 3, 4, 5 items. The amount that you are getting is said to be what? Adjusted total income. And the maximum deduction under section 44C shall be how much? 5% on your adjusted total income. This is what the department says. So let's understand what exactly is this adjusted total income first. So number one, you take your normal total income, then add back the following items. Which all are the items that have to be added back? Number one, head office expenditure under section 44C. What is that? The actual head office expenditure you have claimed. You first add it back, then you check whether it is within ceiling. If it is within ceiling only, you can claim it as a deduction. So you add back the head office expenditure that you have claimed. Then any unabsorbed depreciation you have claimed, then add back. What is unabsorbed depreciation? Not current year depreciation. They are saying unabsorbed depreciation. What is unabsorbed depreciation? Last year or past years you have some depreciation, but you don't have some adequate profit. You will carry forward that depreciation to the future. That is said to be what? Unabsorbed depreciation. You have adjusted some unabsorbed depreciation with the current year profit. Do one thing, you add it back, then compute the adjusted total income. Then what is the third one? First proviso to section 36. Say there is a thing called, if you are a company SSE and incurring family planning expenditure among your employees to promote the concept of family planning, the capital expenditure is allowed as a reduction in 5 equal annual installments under PGBP under section 36. Okay, under 36 PGBP, what it says? If you are a company SSE and incurring family planning expenditure to promote family planning culture among your employees, then you can claim all the capital expenditure as a reduction in 5 equal annual installments. All those installments, that is 1/5 installments that you have claimed from the normal total income, you added back. Okay, you add back that 1/5 of the capital nature family planning expenditure if you have claimed it from your total income. Then what is the next item? Any loss carry forward under 72, that is normal business loss, or 73 speculative business loss, or 74 loss from the head capital gains, or 74A loss from owning and maintaining resources. If you have adjusted normal business loss, speculative business loss, then capital gains loss or loss from owning and maintaining resources from the normal total income, you add it back. If you have claimed any of these losses, you add it back. And what is the last item? All the chapter 6A deduction that you have claimed from the normal total income, you add back. When you add back all these things, you will get a figure. That figure is said to be what? Your adjusted total income. And what is the relevance of adjusted total income here? The maximum deduction for the branch in respect to the head office expenditure shall be either 5% of the adjusted total income or actual head office expenditure, whichever is lower according to section 44C. I hope it is clear. Alright, now we will solve a question so that you will get a better idea on what exactly is 44C. So let's solve a question. So I want all of you to solve this question number 12, which is tested in November 2020 for 6 marks. Okay, so I'll cross off the answer. I want all of you to compute the answer after reading the question. So just go through the question and try to find out the answer, friends. Just go through the question and try to find out the answer. Yes, friends, so let's solve it together. It's actually a very simple question. They have tested again. What is the mark weightage? 6 marks. So the net result of business carried on by the branch of a foreign company in India for the financial year ended 31st March 2024 was profit of 20 lakh after charge of the following expenses. So net result has been given in the question. Depreciation for current financial year is 15 lakh. So what you need to do is compute the income to be declared. Okay, sorry, compute the income to be declared by the branch in its return for assessment year 24-25. So the question they are asking is, what is the total income that have to be shown in the return of the branch? So what you need to do, as you can see, they have claimed all the following expenses as a deduction. Under that, there is head office expenses as well. So you need to check whether it is within ceiling limit under section 44C. So first of all, for determining the ceiling limit, you need to compute what? Compute adjusted total income. So let's compute the adjusted total income first. So for that, as you all know, what all are the things that we require? First you note down the normal total income. So normal total income, how much is the normal total income? It is 20 lakhs. So normal total income is 20 lakhs. Then what do you need to do? Depreciation for the current financial year. What to do? Do nothing. Why? Because current year depreciation is anyways a part of adjusted total income. Unabsorbed depreciation, you need to add back. So unabsorbed depreciation is 17 lakhs that you need to add back. Then what is next? Capital expenditure incurred for promoting family planning among its employees of 7 lakh. 7 lakh is 1/5 of the total expenditure incurred on the promotion of family planning. So family planning capex you have to add back. And how much is that? 7 lakh. That 7 lakh is 1/5. So you need to add back only that 7. Expenditure incurred for scientific research. No problem, you can deduct it. Business loss brought forward. So business loss brought forward you need to add back. How much is that amount? 25 lakhs. Then what is the next item? Deductions under chapter 6A that you need to add back. Deductions chapter 6A and the amount is 20 lakhs. Then head office expenditure is also there, that also have to be added back, that is 1 crore 25 lakhs. So you add back everything, how much is the adjusted total income? 2 crore 14 lakhs will be the adjusted total income. And how much is the maximum limit? 5% on 2 crore 14 lakhs. And how much will be the figure? 10,70,000 is the maximum amount that you can claim as deduction. So you tell me how much will be the total income in the return of that particular branch? Normal total income. So normal total income, as you all know, it is 20 lakhs. From that you add back only head office expenditure right now. That is 1 crore 25 lakh. Then you can deduct the maximum deduction under section 44C and that will be 10,70,000. So can you help me with the net figure? How much is the total income? 1 crore 34 lakh 30,000 is the total income that will come in the return of income of that respective branch. I hope it is clear. Moving on to the next concept, friends, that is 44C. That's what we have completed right now. And now we are moving on to a proviso which is under section 48. It is called as first proviso to section 48, conversion reconversion procedure. We will call it as conversion reconversion procedure. Very simple. If you are a non-resident, you have purchased debentures or shares of a foreign company in foreign currency, not foreign company, Indian company, okay? Debentures or shares of an Indian company in foreign currency. So listen, if you are a non-resident and you purchased debentures or shares of Indian company by making use of foreign currency and now you are selling it. Now you are selling it. When you are selling it, you need to compute capital gain. Yes or no? How do you compute capital gain? First you require full value consideration. Then from that you deduct direct expenses on transfer. Then you will get net sale consideration. From that you deduct cost of acquisition. You will get capital gain. It can be long-term capital gain or short-term capital gain. Hope you remember the formula for computing capital gains. Full value consideration minus direct expense. You will get net sale consideration. From the net sale consideration, cost of improvement and cost of acquisition, if you deduct, you will get the capital gain. It can be long or it can be short. If it is long, then cost of acquisition shall be indexed cost of acquisition. If it is long, then it is index cost of acquisition. If it is short, it's normal cost of acquisition. Okay. Now here what they are saying is, if you are a non-resident and you are purchasing debentures or shares of an Indian company by making use of a foreign currency and you are about to sell it, then while computing capital gain, this procedure have to be mandatorily followed. You have to mandatorily follow this particular procedure, and let's understand what exactly is the procedure that have to be mandatorily followed. So let's start with the first point, and what is that? What department say? First you find out the sales consideration. If it is in Indian currency, then you convert it into what? Foreign currency. That share or debenture that you have purchased, you are selling it right now. The consideration that you are getting, if it is in Indian currency in examination, then you convert it into what? Foreign currency. For the conversion, you require a exchange rate. What is the exchange rate? What department say? You take the average exchange rate as on date of transfer. What do you mean by average exchange rate? You take the average of ask and bid rate. You take the average of ask and bid rate. Ask rate is said to be telegraphic transfer buying rate reported by SBI, and bid rate is said to be, this is bid rate. Ask rate is said to be telegraphic transfer selling rate notified by SBI. Okay, selling rate and buying rate of bank, hope you have studied it in your AFM or SFM, whatever it is. Bid rate and ask rate. We call it as telegraphic transfer buying rate, TTBR, and TTSR, that is telegraphic transfer selling rate, notified by Reserve Bank of India in consultation with, or SBI in consultation with RBI in that respective transfer day. So you take the average of that, then you convert that Indian rupees into foreign currency. Then step number 2, if there is any direct expenses on transfer, then find the expenditure on transfer in Indian currency and convert it into foreign currency. You find out it in Indian rupees, then you convert that into foreign currency. Now for that also you require a currency conversion. What is a currency conversion? Average exchange rate as on date of transfer, not on date when expenditure was incurred. So listen friends, there can be a situation where your date of expenditure and date of transfer is different. If your date of expenditure and date of transfer is different, then you have to take the exchange rate as on date of transfer, not as on date of expenditure. If there is some brokerage and all, if that is in Indian rupee, for currency conversion, you use the average exchange rate as on date of transfer. That's what they are saying. Now, if you have cost of acquisition, find out in Indian rupee and then convert it into foreign currency. For that, the average exchange rate that you have to use is the exchange rate as on date of purchase or acquisition. Now, you will get capital gain in foreign currency because your full value consideration, direct expense, cost of acquisition, everything is in foreign currency. This case, there won't be any cost of improvement. For debenture and shares, you cannot incur any cost of improvement. You cannot construct a fencing for shares. Okay, so there won't be any cost of improvement. Now, the capital gain that you are getting right now will be in foreign currency. Now, you need to reconvert that into Indian rupees. What they are saying is taxable capital gain. Capital gain so calculated in step number 4 will be reconverted into Indian currency at what rate? Buying rate as on date of transfer. So very simple friends, whatever capital gain that you are getting on according to this procedure on date of transfer, which is in foreign currency, have to be converted into Indian rupees by what rate? Buying rate, that is TTBR as on date of transfer. Buying rate you need to convert and you need to compute the taxable capital gain. This is what the department says. Are you all with me? Moving on to the next concept, there are a few notes in relation to this. Note number 1, what they are saying is asset may be long term or short term. You have to mandatorily follow this. Second one, if you are selling units of UTI or mutual fund, you don't need to follow this particular thing. So this will be applicable only for debentures and shares, which is purchased by a NR, that too in foreign currency, not for mutual funds and UTIs. Then, even though if it is a long-term capital gain, you will not get the benefit of what? Indexation. Even if it is a long-term capital asset, you will not get the benefit of indexation. You have to ignore the benefit of indexation. Then, First proviso to section 48 would not be applicable to the capital gain referred under 112A and 111A. In the case of listed security or listed share, 112A will be applicable if it is long term. 111A will be applicable if it is short term. For that, you don't need to do this conversion, reconversion. You can ignore. Then, the method of computation is mandatory, not optional. Okay, this is mandatory. Telegraphic transfer buying or selling rate is the rate of exchange adopted by SBI for purchasing or selling. These are the notes in relation to this conversion, reconversion procedure. So, very simple. You are a non-resident purchasing shares or debentures in foreign currency. Now, you are selling it. When you are selling it for computing capital gain, you compute everything in rupee, convert it into foreign currency. Full value consideration as on the average rate as on date of transfer. Direct expenses same. Cost of acquisition, average rate as on date of purchase or acquisition. This is what. Then the capital gain that you are getting have to be reconverted to rupees. For reconversion, use the TTBR, telegraphic transfer buying rate as on date of transfer. Are you all with me? Let's solve a question, okay? So, I want all of you to go through this particular question. This is a ICA study material question. So, go through this question number 4 and give me the answer, okay? It's a fantastic question. Question number 4 and give me the answer. Alright friends, so we will read the question and we will move on to the answer together. Mr. A non-resident Indian, remits $40,000 to India on 16/9/2008. The amount is partly utilized on 3/10/2008 for purchasing 10,000 equity shares in A Limited. So friends, listen, they are saying the amount is partly utilized. That means this dollars, they have partly utilized for purchasing 10,000 equity shares. That means the purchase happened in US dollars. They make use of US dollars for the purchase. Are you all with me? So, they make use of US dollars for the purpose of purchase. That's what they are mentioning in the question. Great. Now, these shares are sold for 48 rupee per share on 30th March 2024 and the fair market value of these shares as on 31st January 2018 was 35 per share. So, first of all, they are telling that compute the capital gain. These shares have not been sold through recognized stock exchange. You have to compute the capital gain for the assessment year 24-25 if they are not selling it through a recognized stock exchange. If they are not selling it through recognized stock exchange, then as you all know, you have to make use of that first proviso to section 48. Are you with me? Now, so first of all, we need to compute the full value consideration, 48 rupee per share into how many shares? 10,000 shares, and the amount in rupees will be 4,80,000. You need to convert it into foreign currency. Here, what is the date of transfer? When is the date of transfer? It is on 30th March 2024. Buying rate is 59, selling rate is 61. So, average rate will be how much? 60 rupee per dollar. So, you have to divide this 4,80,000 with 60 rupee per dollar. And can you help me with the math? How much will be the dollar value? $8,000. Now, you need to compute the cost of acquisition. They are saying that 12 rupee per share is the cost of acquisition into 10,000 shares. It will be 1,20,000. Now, you need to divide it with the average exchange rate as on date of purchase. When is the date of purchase? It is on 3/10/2008. 3/10/2008, 19 and 21. So, the average rate will be 20 rupee per dollar. Are you with me? So, 20 rupee per dollar, you have to divide it with 20 rupee per dollar. And can you help me with the math? $6,000. So, if you deduct 6,000 from 8,000, the value will be $2,000. Now, you need to reconvert it with the buying rate as on date of transfer. What is the buying rate as on date of transfer? 59. According to the question, it is 59 rupee per dollar. So, you need to reconvert that is 59 rupee per dollar into $2,000. And how much will be the value? 1,18,000 is the taxable LTCG, and that is the answer to question number 1. 1 means A. Now we have one more question, that is question number B. What is question number B? That is kind of a sub question here. What is B? These shares have been purchased and sold through a recognized stock exchange. What if you are purchasing and selling these through a RSE? Let's understand, if it is through an RSE, then it is a long-term capital gain mentioned under 112A. So long-term capital gain under section 112A. If it is a listed share transfer, then you don't need to follow the first proviso and second proviso to section 48. That is not required. So what we can do here is, full value consideration will be how much? 48 into 10,000, that will be 4,80,000. But here there is a small twist in the question. That simply means you purchased the shares in 2008. According to the theory under 112A, there are certain specialities we are purchasing a listed share before 31st January 2018. Hope you have studied it. If you are purchasing a listed share before 31st January 2018, then while determining the cost of acquisition, what is the speciality? You take the original cost of acquisition first. That is, how much will be the original cost of acquisition? 12 rupee. Okay. Now you need to pick the lower of fair market value as on 31st January 2018. How much is the fair market value as on 31st January 2018? 35. Then you need to compare it with the full value consideration at the time of transfer. How much is the full value consideration at the time of transfer? 48. Compare these two. Pick the lower. Lower is 35. Then compare this 35 with the original cost of acquisition 12 and pick the higher. So 35 will be the original cost of acquisition according to the formula. So what we can use is, cost of acquisition will be 35 into 10,000 shares, and that will be 3,50,000. Deduct these two, it will be 1,30,000, and that is the taxable LTCG. Don't deduct 1 lakh from here. Under 112A, while computing tax only, you can take the advantage of rupees 1 lakh. In other cases, you are not supposed to take. I hope that is also clear for you. So moving on with the next concept, friends, we were discussing 44, first proviso to section 48. Now we will discuss 115C, D, E, F, G, H, I. We will discuss all these provisions together. Okay, we are about to discuss all these provisions together right now. Alright, so without wasting time, let's start with 115 C, D, E, F, G, H, I. First of all, listen. For applying these provisions, you have to be an NRI. This is the first thing that you should know. These provisions, that is 115 C, D, E, C, D, E, F, G, H, I. 6 provisions. C, D, E, F, G, H, I. 7 provisions are there. These 7 provisions shall be applicable only for NRIs. Who is an NRI? Non-resident Indian. Who is a non-resident Indian? That simply means the provisions of this chapter are applicable to a non-resident Indian who derives investment income or long-term capital gain. And first of all, let's understand who is non-resident Indian. So non-resident Indian means Indian citizen or Indian origin who is not a resident. That simply means you are an Indian citizen or Indian origin, but you are currently non-resident in India. Alright, you are an Indian citizen or an Indian origin, but currently you are a non-resident in India. You will be called as a NRI for the purpose of 115 C, D, E, F, G, H, I. And you are an NRI. And you are having investment income or long-term capital gain from foreign exchange assets. You have what? Either investment income or long-term capital gain from what? From foreign exchange assets. Now the question is, what exactly is foreign exchange asset? You should know what is foreign exchange asset right now. So friends, let's understand what exactly is this point. The provisions of this chapter are applicable to NRI who derives investment income from foreign exchange asset or long-term capital gain on transfer of foreign exchange asset. So you should know what is foreign exchange asset. So foreign exchange asset simply means, this is the definition. 115C says foreign exchange asset means below assets purchased in foreign currency. If you are purchasing the below assets that in foreign currency, then that is said to be what? Foreign exchange assets. Which are the assets? Number one, shares in an Indian company, debentures of a public limited Indian company, deposits in a public limited Indian company, securities of central government or any other assets notified by the central government. You are an NRI and you are purchasing shares of an Indian company or debentures of a public company or deposits in a public company or securities of CG or any other assets notified by CG in foreign currency. That asset is said to be what? Foreign exchange asset. And you are deriving some dividend income or interest income or long-term capital gain on transfer of these assets, then these provisions are applicable for you provided you are a NRI. So you have to be an NRI, you should have a foreign exchange asset and you should have either interest income or dividend income or you have long-term capital gain from the respective assets. Now, what is the speciality if you have this income? For investment income, the rate of tax will be how much? 20%. If you are an NRI having investment income from these specified assets, then the rate of tax for that investment income is how much? 20% plus surcharge if any plus cess. What is the surcharge if any? Depends upon the size of your total income. Okay, your salary total income more than 50 lakh individual, then 10%. More than 1 crore, 15%. More than 2 crore, 25. More than 5 crore, 37%. These are the surcharge slabs for a individual. Now, if you have long-term capital gain, then how much is the rate of tax? Only 10%. If you have long-term capital gain from transfer of these assets, then it is subjected to a rate of only 10%. That's what the department says. Plus surcharge if any plus cess. Very simple. Investment income, rate of tax 20%. Then long-term capital gain, rate of tax 10%. This is it. Now, while computing these two incomes, no deduction on any expenditure is in computing the investment income. You cannot claim any expenditure as a deduction from the investment income. That also means you can claim direct expenses as well as cost of acquisition while computing long-term capital gain. For a better clarity, I have given a chart under this. Okay, so expenditures while computing investment income not allowable, but while computing long-term capital gain, direct expenses on transfer and cost of acquisition is allowable. Then first proviso to section 48. What is that? Conversion reconversion procedure. NRI means non-resident. Purchase of specified asset in foreign currency means share or debenture can be purchased in foreign currency. Now you are selling it. Then you have to follow mandatorily the conversion reconversion procedure. What is that? Full value consideration in Indian rupees have to be converted to foreign currency. Cost of acquisition in Indian rupees have to be converted to foreign currency. Then you compute the capital gain and reconvert everything to Indian rupees. Hope you remember. That procedure also will come here. Are you with me? So, how about second proviso, indexation? For investment income not applicable, for long-term capital gain not allowable. You cannot claim the benefit of indexation. Chapter 6A reduction, not allowable, not allowable. So what is the allowable thing? While computing investment income, you cannot claim any expenditure. While computing long-term capital gain, you can claim direct expenses as well as cost of acquisition. No indexation. Then first proviso to section 48 applicable. That means conversion, reconversion you have to mandatorily do. No chapter 6A reduction from investment income as well as long-term capital gain. This is what they are saying. Are you all here? Great. Now, listen. So, no chapter 6A and no indexation for long-term capital gain. Now, friends, listen. There is another thing called 115F. Let's understand what exactly is this 115F. Say, if you are transferring a specified asset, you are transferring a foreign exchange asset from the long-term capital gain you can claim an exemption under section 115F. On account of transfer of foreign exchange asset and you are investing amount in another specified asset. Just like your 54 capital gain exemption, you are selling old house and purchasing new house, you will get an exemption. Likewise, you are selling specified asset and you are making use of that money to purchase another specified asset. That means you are reinvesting. You can claim that reinvested amount as an exemption under section 115F. Let's understand how to claim the exemption. So please listen. Where an NRI has transferred long-term foreign exchange asset and within a period of 6 months after the date of transfer, invested the net consideration in any other specified asset, then exemption is as follows. First of all, listen. You are transferring a foreign exchange asset and you are purchasing another foreign exchange asset within 6 months from the date of transfer. Then you are eligible to claim the exemption, and how to compute the exemption, that's what we are about to discuss. Let's understand how to compute the exemption. Long-term capital gain into amount invested in new asset divided by net sale consideration. That simply means, listen, when you are selling your shares or debentures, okay, you will get a long-term capital gain. And how to compute exemption? Amount invested in new asset divided by net sale consideration. So friends, listen, only focus this area. What is the equation of this area? Amount invested in new asset divided by net sale consideration. That fraction simply means out of your net sale consideration, how much you are investing in the new asset. That percentage on long-term capital gain is your exemption. Out of your net sale consideration, how much you are investing in the new asset, that percentage on long-term capital gain. That simply means you are completely investing all the net sale consideration in purchasing new asset. Then entire long-term capital gain is exempted. You are only investing 50% of the net sale consideration for purchasing new asset. Then only 50% is exempted. Are you with me? There is no requirement to by heart this particular equation. You don't need to by heart this equation. It's very simple. Out of NSA, how much you are investing in the new asset, that percentage on the long-term capital gain is your exemption. That's what the department says. Moving on. Now, let's move on. Once you have purchased this new asset and claimed the exemption, then for the next 3 years you are not supposed to sell that particular asset. That means lock-in period for such new asset shall be for 3 years. Once you have purchased that, once you have sold that particular old asset and you are purchasing that amount in a new asset within 3 years, then there is a lock-in period for that. And how much is the lock-in period? 3 years. That means for the next 3 years, you are not supposed to sell that new asset. For the next 3 years, you are not supposed to sell that new asset outside. Now, what if you have sold it? On premature transfer, the benefit availed earlier under this section shall be taxed as long-term capital gain in the previous year in which new asset is transferred or converted into money. If you are violating this year of violation, both the long-term capital gain that is exempted earlier shall be fully taxable here. So the exemption that we have given to you based on a condition that for the next 3 years you are not supposed to sell it outside. If you are selling it outside, don't worry, the exemption that you have claimed earlier, you consider it as your deemed long-term capital gain in year of violation of this particular condition. I hope you got my point. Now, when you are selling this new asset, there will be a capital gain on account of that transfer. Plus there will be reversal of the exemption that you have claimed earlier as well. So both will come. Okay, when you are selling an asset, there will be capital gain computation. Plus the capital gain that is exempted earlier on a condition that you will not sell it for 3 years, that you violated, that also will come into the picture. That's what we have to understand. Now, if the assessee does not have any other income apart from investment income and long-term capital gain, plus TDS has been correctly deducted, thereafter he is not supposed to file any return. Say assessee does not have any investment income and assessee does not have any other income other than investment income and long-term capital gain. That simply means you have only this long-term capital gain and investment income. Plus your TDS has been correctly deducted. Then no need to file any return. You are absolved from filing income tax return. Another advantage, at the time of purchasing the shares or debenture, you was a non-resident, you are a non-resident, you were a non-resident. Okay, at the time of purchase of shares or debenture or deposit, you were a non-resident. Thereafter you came back to India. Once you become resident in India, these provisions are not applicable for you. So till last year, I was like a non-resident. This year I become a resident. From this year onwards, for investment income and long-term capital gain will be subject to the normal rates. Yes or no? But department say, one thing, will give you another advantage. If you are an NRI earlier, now you become a resident. You want to enjoy these provisions. Give us a declaration. If you give us a declaration that you want to claim the benefit of these sections, you can still claim the benefit of this section for the investment income. So what they are saying is, where a person who is an NRI becomes accessible as a resident in subsequent year, then he may furnish a declaration to continue to the applicability of the above provisions. If he does so, then investment income alone shall be taxable under this provision until the transfer or conversion into money of such asset. That means investment income, you can continue the benefit of this section even after you become a resident in future. Don't worry. And to the final thing here, if you really think that these provisions are not beneficial for you, we are not mandating to apply for these provisions. An assessee may elect not to be governed by this provision for an assessment year. If he does so, the provisions of this chapter shall not apply to you. Just like an option, you can opt out also. What is opt out? By default, you will be guided under 115 CDEF GHI. But we are not mandating it. You really think that these provisions are not beneficial for you, you do one thing, you opt it out. You can opt out from these provisions and you can choose the normal provisions. Nobody is compelling you to follow these sections, but in examination, ICA will compel you to follow these sections, okay? Simply you cannot take assumption. I am opting out because I don't know what is CDEF GHI. That is not possible. For examination, this is mandatory. But in practical life, there is a choice for the assessee. You can opt out from these beneficial provisions as well. In examination, if they are not saying anything, by default, this will be applicable. Okay, that's what you should know. Now let's solve a question for a better understanding of this provision. So listen. So I want all of you to go through this question. This is actually a very simple question. Go through this question number 6. Okay. It's a pretty simple question. Go through this question and give me the answer. It's a very easy question. Yeah. So let's solve that question together, friends. Mr. John, a non-resident Indian, purchased shares of an Indian company at what cost? 2,50,000. That's what they, 70,000. The cost is 70,000 on 1/7/2012 in foreign currency. Mr. John sold the said shares for consideration of 2,50,000. So there is a sales. Now you tell me, how much is the full value consideration? 2,50,000. Yes or no? How much is the cost of acquisition? 70,000. Before that, is there any direct expenses on transfer? Yes. So we will deduct the direct expenses on transfer. How much is the direct expenses on transfer? 10,000. So how much will be the net sale consideration? 2,40,000. Now, how much is the cost of acquisition? 70,000. Can you claim the benefit of indexation? Answer is no. Why? That doesn't, because of index number is not given in the question, okay. That is why, because under 115 CDEF EG, 115 CDEF GH high provisions, under D, it is specifically mentioned that while computing long-term capital gain, you are not supposed to claim the benefit of indexation, okay. So indexation is not allowable. So tell me, how much is the long-term capital gain? 2,40,000 minus 70,000, 1,70,000. Now is he eligible for any exemption? Yes. He deposited 1,50,000 out of the sale consideration in specified asset. So the date is not given in the question. So we are assuming that it is within 6 months. Okay. So if it is within 6 months, how do you compute the capital gain? Exemption. 1,70,000 is the total capital gain into 1,50,000 is the investment divided by 2,40,000 is the net sale consideration. So can you help me with the math? 1,06,250. So that is the exemption. So 1,06,250 is the exemption. You claim that exemption. How much will be the taxable gain? 63,750 will be the taxable gain. I hope that point is clear for you. Alright friends, so we will be completing the other provisions in this particular chapter. Now we have 115A, that is the lengthiest section out of everything, okay. So let's cover the lengthiest section in NR taxation, that is section 115A. We will take at least half an hour to complete this 115A. It is that much lengthy. So listen, so friends, let's understand what is this 115A. A lot of incomes rates are provided under 115A. So instead of making use of this chart, I will make you draw certain other charts. Okay, let's draw all the charts. We will draw different charts for all different rate of taxes. So without wasting time, let's complete 115A. Alright, so moving on to the first one. Say you are a non-resident or a foreign company. You are a non-resident or a foreign company. Alright friends, so it's time for us to start with section 115A. Let's understand what exactly is this section 115A. So under this particular session, the first thing that you should know is the different rate of tax applicable for non-residents. So we will draw a chart based on the theory under 115A. So friends, yes, to start with the different charts. So I want all of you to take a note of this charts. Okay, so open your notebook and take a note of this charts. So chart number 1, let's understand what is chart number 1. It says, say you are a non-resident or a foreign company. So you are a non-resident or a foreign company and you are in receipt of dividend. You are in receipt of what? Dividend from Indian companies. From Indian companies. So if you are receiving dividend from Indian companies, then as you all know, you have to pay taxes in India. So for that, what is the rate of tax? According to section 115A, rate of tax shall be at 20%. According to 115A, the rate of tax shall be at what rate? 20% rate. This is what the department says. And there is one speciality. Okay. If this Indian company is located in, IFSC, that is International Financial Service Center, then instead of 20%, all the dividend received by NR or foreign company shall be taxed at 10%. So rate of tax shall be at 10%. So if you are a company which is incorporated in International Financial Service Center, IFSC, then department say, we are giving you a benefit. That company, when they declare a dividend, whoever receives that dividend is subjected to pay only 10% as the rate of tax under section 115A. So if you are a company located at a normal place or a normal area, then the rate of tax for the shareholder shall be 20%. If you are a company which is located in a IFSC, then instead of 10%, 50% discount. They are only saying you pay tax at what? 10%, that's it. Now that is chart number 1, and let's move on to chart number 2. And let's understand what exactly is the other things under this particular 115A. So say friends, you are a non-resident or a foreign company. Say you are a non-resident or a foreign company and you have given a loan or you have entered into a loan agreement with an Indian concern or government. You have entered into an agreement with an Indian concern or with a government of India, and this is actually a money borrowed in foreign currency, So if you have borrowed money in foreign currency from a non-resident or a foreign company, then this Indian concern or government have to pay what? Interest. So this interest is subjected to a rate of tax a rate of tax at again 20%. So department say, if you are a non-resident or a foreign company and you have given a loan to an Indian concern or government of India, and if that Indian concern or government of India is paying you interest, then the rate of tax for that interest shall be at 20%. This is what the second item under 115A is all about. Moving on to the third item under 115A, item number 3, what it says is, say for example you are a non-resident or a foreign company and you have an agreement with an Indian company, you have an agreement with an Indian concern, we can say Indian concern or government of India, you have an agreement with Indian concern or government of India. So based on this agreement, this Indian concern or government of India is paying royalty or fees for technical services. Royalty or FTS, fees for technical services, and it is not covered under section 44DA. We have to write not covered under section 44DA. Then you tell me what is the rate of tax for this royalty and FTS. Rate of tax for this royalty and FTS shall be at 20%. Yesterday, hope you remember, we have discussed the same provision under 44DA. If the taxability is not under 44DA, then definitely it will be taxable under 115A at what rate? A 20% rate of tax. This is what the department says. I hope it is clear. That is point number 3. And let's understand what exactly is point number 4. So point number 4. Say for example, you are a non-resident or a foreign company. You are a non-resident or a foreign company and you have invested in infrastructure debt fund. Infrastructure debt fund. So you are a non-resident or a foreign company and you have invested in infrastructure debt fund. From infrastructure debt fund, you will definitely receive what? Interest. If you are in receipt of interest, then the rate of tax shall be at 5%. Rate of tax shall be only at 5%. Okay. So if you are a non-resident or a foreign company and you have invested in infra debt fund and you are receiving interest from that respective debt fund, then that interest is subjected to a rate of tax only at 5%. This is what the department says. I hope that point is also clear for you. Moving on with the next one. What is the next point? Say you are a non-resident or a foreign company, that will never, there won't be any change for the non-resident or a foreign company anyways. Okay. Say point number 5, you are a non-resident or a foreign company and what you have done, say you have given a loan, to an Indian company or a business trust, to an Indian company or a business trust. Okay, so money borrowed in foreign currency. The borrowal has happened in foreign currency and based on an agreement. Based on an agreement which is approved by central government. Approved by central government. Based on an agreement approved by central government and made between, and this agreement is made between 1st July 2012 and 30th June 2023. 30th June 2023. So you are a non-resident or a foreign company, you have given a loan to an Indian company or a business trust, and this money borrowed by the Indian company or business trust is based on an agreement signed between them which is approved by the central government, and the money borrowed or the agreement is made between 2012 and 30th June 2023. On this loan also, Indian company or business trust will definitely give what? Interest. This interest, the rate of tax will be at again 5%. For this interest also, you need to pay a rate of tax at 5% only. This is what the department says. So friends, don't confuse this with chart number 2. What was chart number 2? A non-resident or a foreign company gives a foreign currency loan to any Indian concern or to the government, irrespective of date of agreement and irrespective of other condition. If you are getting any interest, that interest is subjected to 20%. We can say common interest, general interest for loan in foreign currency. But chart number 5 is a little bit specific. You are a non-resident or a foreign company giving a loan to an Indian company or a business trust, and that loan is based on an agreement which is made between 2012 and 2023. That agreement should be approved by the central government as well. In such a case, if you are receiving interest, then the rate of tax shall be at 5%. This is what the department says as point number 5. So, moving on to point number 6. Let's understand what exactly is point number 6. So, what are they saying as point number 6? So, listen, you are a non-resident or a foreign company. You are a non-resident or a foreign company and you have invested in long-term bonds of Indian company or business trust. You have invested in long-term bonds of an Indian company or business trust, and this investment happened between, and the investment is made between 1st October 2014 and 30th June 2023. That investment is made between 1st October 2014 and 30th June 2023. On this also you will get interest. On this investment also you will get interest, and what is the rate of tax for this? Rate of tax shall be at 5%. For this interest also the rate of tax shall be at what percent? 5%. So, you are a non-resident or a foreign company invested in long-term bond of an Indian company or a business trust, and this investment happened between 2014 and 2023 June. You are getting any interest from this? That interest is also subjected to a rate of only 5%. This is what the department says. I hope that point is also clear for you. Now, moving on to the last point under this, not last point, another point under this, that is point number 7. So, what point number 7 is all about? That is, you are a non-resident or a foreign company and you have invested in rupee denominated bond. You have invested where? In rupee denominated bond. And one more thing is there, friends. Listen, the investment in long term bond should be in foreign currency. Okay, it should be foreign currency and approved by CG. Okay, it should be in foreign currency and it should be approved by the central government as well. You have to add these two also. The long term bond investment have to be approved by the central government, and that investment have to happen in foreign currency as well. Now, moving on to the next point, that is non-resident invested in rupee denominated bond. What is rupee denominated bond? A bond which is denominated in rupees. Okay, so rupee denominated bond, and this investment is before, this investment happened before 30th June 2023. This investment happened before 30th June 2023. On this investment also you will get what? Interest. And the rate of tax for this shall be at 5% again. Okay, on this interest also the rate of tax shall be at 5%. This is what the department says. So, the point is very simple. You are a non-resident or a foreign company invested in rupee denominated bond and you are getting interest, and that interest is subjected to a rate of tax only at 5%. So, all these items are actually interest. Okay, all these items, that is point number 2. Point number 2 it was interest, then point number 4, then 5, then 6 and 7. Everything is related to interest incomes only, but the conditions and other things are actually different. Moving on with the next item. There are some IFSC points are there. For the time being, I am ignoring that particular point because not very important for us. So, another important thing under this point is, say you are a foreign institutional investor. That is point number 8. Say you are an FII, that is foreign institutional investor, or a QFI, qualified foreign investor. Say you are an FII or QFI and you have invested in rupee denominated bond. Rupee denominated bond of an Indian company, or you have invested in government security. Either you have invested in rupee denominated bond of an Indian company or you have invested in a government security. It can be any of these investments. And on this investment, so we can write rupee denominated bond or government security, okay? Either rupee denominated bond or government security. Now friends, listen, on this investment you will get what? Again, interest. Based on this investment you will get interest, and it is receivable, interest receivable between 1st April 2020 and 30th June 2023. You are receiving interest between 2020 and 2023. In that case, rate of tax shall be at 5%. So here it is not the investment date, it is the interest receipt date. Interest receivable between 1st April 2020 and 30th June 2023. Then based on that, if you are receiving that interest, then the rate of tax shall be at 5% only. This is what the department says. Now, not yet over. Point number 9. Point number 9 again related to FI or QFI. So, you are an FII or a QFI. Say you are an FII or a QFI and you have invested in municipal debt security. You have invested in municipal debt security. You have invested in municipal debt security and you are receiving what? Interest. Okay. Interest receivable between 1st April 2020 and 30th June 2023. Interest receivable between these two periods. Then again rate of tax shall be at 5%. Rate of tax at 5%. This is what the department says. So these are related to FII and QFI. Point number 8 and point number 9 are related to FII and QFI. Now, the next important item, one more important item is there. So that is, say you are a non-resident or a foreign company, that is item number 10. You are a non-resident or a foreign company and you have purchased UTI. You have purchased UTI or mutual fund units, unit trust of India units or mutual fund units in foreign currency. In foreign currency. Say you are a non-resident or a foreign company and you have purchased what? Units of UTI or mutual fund in foreign currency, and for that you will get an income, just like an investment income. This income is subjected to a rate of tax at again 20%. Rate of tax at 20%. This is what the department says. So these are the important 10 items under 115A. So let's revise all the items in a go. What was item number 1? non-resident or a foreign company getting dividend from an Indian company, normal rate of tax is 20%. If the Indian company is located in IFSC, then the rate of tax will become 10%. Second point, non-resident or a foreign company have given a loan in foreign currency to any Indian concern or a government, you are getting interest, rate of tax shall be 20%. Third one, non-resident or a foreign company based on an agreement provides some royalty or FTS services to Indian concern or a government. It should be approved by the government based on an agreement and they are getting royalty or FTS. It is not covered under 44DA, then it is covered at 115A and the rate of tax shall be at 20%. Then what is item number 4? Non-resident or a foreign company invested in infrastructure debt fund. There is no condition, nothing. All the interest income from infra debt fund shall be taxed at only 5% always. Moving on to the next one, non-resident or a foreign company have invested in any Indian company or a business trust. This investment is actually a kind of a borrowal that is based on an agreement which is approved by the CG and the date of agreement shall be between 1st July 12 and 30th June 23 and you are getting any interest on this borrowal, the rate of tax shall be only at 5%. Then non-resident or a foreign company invested in long-term bond that is in foreign currency and which is approved by the central government. And this investment happened between 2014 and 30th June 2023. This investment is in the Indian company or a business trust and you are getting any interest, the rate of tax shall be at 5% again. Then non-resident or foreign company invested in rupee denominated bond before 30th June 2023, then all the interest is subjected to a rate of tax only at 5%. Then moving on to the next one, FII or QFI invested in a rupee denominated bond or government security, then they are getting any interest that is between 1st April 2020 and 30th June 2023, then the rate of tax again shall be at 5%. Moving on to the next one, FII or a QFI invested in a municipal debt security, interest receivable between 2020 and 2023, that is also subjected to a rate of tax only at 5%. That's what the department says. To the last one, that is a non-resident or a foreign company purchased in foreign currency of units of mutual fund or UTI, then all the income shall be taxed at what rate? 20% rate of tax. So these are the items that are covered under 115A. I hope that point is clear for you. Now we have some conditions under 115A. You should know the conditions as well. So these are the conditions under 115A. So listen. So we have discussed many items. Okay. So while computing the income, you are not supposed to take any deduction. So what department says is deduction under section 28 to 44C and under section 57 is not allowed in computing above income, that is interest, dividend, royalty, FTS. Under section 115A, we have discussed about different types of interest, dividend, royalty and fees for technical services. While computing this income, you are not supposed to claim any direct expenses as a deduction. You cannot claim any expenses as a deduction. These are a flat rate taxes. On the gross income, you have to pay the taxes. This is what the department say. Now, the next question is, can you claim chapter 6A deduction? Again, what department say is, deduction under chapter 6A is not available in computing income from interest and dividend as above. Under 115A, while computing the interest income and dividend income, you cannot claim any chapter 6A deduction. That also means you can claim chapter 6A deduction from royalty income and FTS income. From royalty and FTS, you can definitely claim chapter 6A deduction, but not from interest and royalty. Not for interest and dividend. Moving on to the next one, is return required? So what department say? The total income should consist only of dividend, interest, royalty, FTS as above, and TDS has been deducted correctly. If there is any other income, then return required. That simply means, say for example, assessee only have either royalty or FTS or interest or dividend. Assessee does not have any other income. Assessee only have those 4 incomes mentioned under 115A. Plus, while getting this income, TDS has been correctly deducted. Whoever pays this income have been correctly deducted the TDS under the respective sections. If both the conditions are satisfied, then that non-resident or a foreign company is not required to file return. You are absolved from filing return requirement. You don't have to file your returns in India. Say you don't have any other income apart from these 4, plus TDS have been correctly deducted, then you don't have to file your returns in India. That is the greatest advantage that you can have. Now, what about set off and carry forward? from the above income, set off and carry forward of losses is permitted. You can definitely claim set off and carry forward of losses from the above income. And how about unabsorbed depreciation? You cannot charge unabsorbed depreciation from the above income. Except unabsorbed depreciation, you can claim all other normal business loss and other things from the above income. You cannot claim any unabsorbed depreciation from the above income. That's what they are saying. So there are major 4 things that you should know. First of all, non-deduction. Second one, no chapter 6A deduction except for royalty and FTS. No return requirement if TDS has been correctly deducted. And set off and carry forward permissible except unabsorbed depreciation. So these are the conditions under 115A. Now let's solve a small question. So friends, I want all of you to go through this question number 7 and give me the answer. It's actually a simple question. So go through this question number 7 and give me the answer. It's actually a very good question, okay? So let's solve it together, friends. So I'll read the question from here. Jake, a foreign national, furnishes the following data for the previous year ended 31st March 2024. So he have given some data. Royalty from Indian concern under an agreement made on 15/9/1996, approved by the central government 3 lakh. So royalty means which section? The date of agreement is 1996. So it is not under 44DA. So it will be under 115A. So this royalty of rupees 3 lakh will be taxable under 115A. Now the question is, can you claim this 2 lakh expenditure as a deduction? No, because under 115A, it is gross based taxation. You cannot claim any expenditure as a deduction. Moving on. Interest from Indian company on money lent in foreign currency 11 lakh. So it's an Indian company, money lent in foreign currency. So anyways, the taxability will be under 115A. 115A, so 11 lakh. Now, can you claim any expenditure as a deduction? No, you cannot claim any expenditure as a deduction over there as well. Now, gross sale of business in India. That will be taxable as a normal income because that is your normal business income. And there is expenditure 28 lakh. So can you claim this expenditure as a deduction? Yes, you can claim this expenditure and effectively only 2 lakh will be taxable. Now, donation to Prime Minister's National Relief Fund. It is a deduction under 80G. Under 80G, there are 4 categories of deductions. Category number 1, 100% without ceiling limit. Category number 2, 50% without ceiling limit. And category number 3, 100% subjected to ceiling limit. And category number 4, 50% subjected to ceiling limit. This Prime Minister's National Relief Fund will come under category 1. That is 100% without any ceiling limit. But there is a problem. What is your GTI? How much is your gross total income in this question? 3 plus 11 plus 2, that is 16 lakh. But out of this 16 lakh, this 11 lakh is related to the interest income under 115A. From interest income and dividend income under 115A, you cannot claim any chapter 6A deduction. So how much is the eligible income? It is only 3 plus 2. From royalty income, definitely you can claim. And PGBP income, definitely you can claim chapter 6A deduction. So the eligible income shall be 3 plus 2. So even though the deduction is 8 lakh, it shall be restricted to 5 lakhs. Yes, restricted to 5 lakhs. That's it. So the remaining 11 shall be fully taxable. That shall be the taxable total income of the assessee. I hope that point is clear for you. Are you all with me? So that's it. So this is how you have to find out the answer if they are testing 115A. I hope it is okay for you. Now let's move on with the other flat rates under this chapter. Now we don't require any chart and all because the other things are comparatively easy only. So let's discuss the other things in relation to this particular chapter. So moving on with the next section, that is 115AB, that is tax on income from units purchased in foreign currency or capital gains. So friends, listen. Say you are a overseas financial organization. What do you mean by overseas financial organization? There is a note for the definition. Overseas financial organization means any fund, institution, association or body, whether incorporated or not, established under foreign law, which has entered into an agreement for investment in India with any public sector bank or a public financial institution or a mutual fund, and such arrangement should be approved by SEBI. So overseas financial organization simply means you are say for example, you are a fund or an institution or an association or a body which is established as per any foreign law, and you are planning to invest in India with any public sector bank or a public financial institution or a mutual fund, and it should be approved by SEBI as well. So we can say a foreign bank, a bank which is incorporated as per foreign law, which is about to come and invest in India with the SEBI approval, can be called as an OFO. What is that? Overseas Financial Organization. Are you with me? Now, this 115AB is applicable only to OFOs, that is Overseas Financial Organizations. So, let's understand what exactly is this Overseas Financial Organizations taxability. So, what department say is, income from units of UTI, mutual fund, purchased in foreign currency. Say for example, you are an OFO and you have income from UTI or mutual fund which is purchased in foreign currency. Just like an investment income, you have income from UTI or mutual fund which is purchased in foreign currency. Or you are selling these units and you have a long-term capital gain. Either you have a long-term capital gain on account of transfer of units of UTI or mutual fund, or you have investment income from UTI or mutual fund units which is purchased in foreign currency. Both the cases, both incomes are taxed at what rate? 10% flat rate under section 115AB. Are you all with me? Are you all with me? So what 115AB says, you are an OFO and you have either investment income from UTI or mutual fund units which is purchased in foreign currency, or you have long-term capital gain on transfer of these two. Both the incomes are taxed at only 10% rate of tax, and there are certain other conditions also in relation to this. Let's learn the conditions one by one. And moving on to the first condition, expenses under section 28 to 44C and under section 57 not allowable. While computing the investment income, assessee is not supposed to claim any expenditure as a deduction. But while computing long-term capital gain, direct expenses and cost of acquisition is definitely allowable. While computing long-term capital gain, you can claim both the direct expenses and cost of acquisition. But while computing investment income, it is taxed on gross income, not on the net income. That means you cannot claim any expenditure as a deduction. Next one. First proviso to section 48, that is conversion, reconversion, not applicable, not allowable. So while computing long-term capital gain, you are not supposed to convert and reconvert because that is only applicable for shares and debentures purchased by a NR in foreign currency. For mutual fund units, that is not applicable. Then second proviso to section 48, that is benefit of indexation. While computing investment income, it is not at all applicable. But while computing long-term capital gain also, it is not allowable. Even though it is long-term capital asset, you cannot claim the benefit of indexation because we are only taxing you at 10% rate of tax. So we will not give you the benefit of indexation. That's what the department say. And can you claim the benefit of chapter 6A? Not allowable, not allowable. From both investment income and long-term capital gain, assessee cannot claim the benefit of chapter 6A deduction as well. Now, say set off and carry forward of losses are definitely applicable. You can definitely claim set off and carry forward of losses, but unabsorbed depreciation not allowable. Why unabsorbed depreciation not allowable? Because it comes under section 28 to 44C. The section of unabsorbed depreciation is 32 subsection 2. So you cannot adjust any unabsorbed depreciation. You can only adjust what? Normal loss and other losses as per the set off and carry forward provisions. One more thing is there. Say if the unit is unit of equity oriented fund. Oriented fund. What do you mean by equity oriented fund? A mutual fund which focuses only on equity can be called as an equity oriented fund. If it is a listed equity oriented funds unit, then the taxability will be under section 112A, not under 115AB. Are you with me? Say for example, the units of UTI or mutual fund, if it is related to a equity oriented fund which is listed in an RSC, that is recognized stock exchange, then the taxability will be as per 112A if it is long term and 111A if it is short term. You are not supposed to consider it under 115AB even if you are an OFO. That's what the department says. I hope that point is also clear. So that was 115AB. That is taxability for OFOs. Okay friends, now we will move on and discuss 115 AC. So let's understand what exactly is this 115 AC. So please focus. Section 115 AC, rate of tax on income from bonds, GDR, capital gain arising on its transfer. So let's understand, if you are a non-resident having any of these incomes, then the rate of tax applicable for you shall be at 10%. That's what the department says. So it is applicable only for non-residents. And what is item number 1? If you are a non-resident and you are having interest income on bonds of an Indian company issued in accordance with the central government scheme and purchased in foreign currency. Say for example, you are a non-resident, you have purchased bonds of an Indian company which is issued in accordance with any scheme of CG, and you have purchased it in foreign currency. Now you are getting some interest income from that particular bond, then the interest income shall be subjected to a rate of tax at 10%. So please listen, you are a non-resident and you have purchased what? Bonds of an Indian company which is issued in accordance with any central government scheme or a plan, and your investment is in foreign currency, and now you are getting interest income from that particular bond and you are a non-resident. That interest income will be subjected to only 10% rate of tax under section 115 AC. Moving on, you are receiving interest on bonds of a public sector company sold by central government. The central government is selling some bonds of a public sector company and you are a non-resident and purchased it in foreign currency. Again, you are getting interest income from that particular bond. That interest income is also subjected to a rate of tax at 10%. Next one, you are receiving dividend income on GDR. What is GDR? Global Depository Receipts. You have invested in some GDR and you are receiving dividend income from GDR. That dividend income is also subjected to 10% rate of tax. Or you are selling the above bonds or GDRs. You are selling these bonds or the GDR and you have long-term capital gain. That is also subjected to 10% rate of tax. So 4 types of items are there. Number 1, interest from any bond of an Indian company which is issued in accordance with CG and NR purchased it in foreign currency. That interest. Then point number 2, interest in relation to bonds of a public sector company sold by the CG and your investment is in foreign currency. Number 3, dividend from GDR. Number 4, long-term capital gain on account of transfer of these 3 assets. All these 4 incomes are subjected to what rate? Only 10% rate of tax under section 115 AC. I hope you got my point. Now while computing this also, there are certain notes that you should know. Starting with the first one, indexation and conversion reconversion does not apply while computing long-term capital gain. Here, you don't need to convert and reconvert it into foreign currency and Indian rupee. That procedure is not applicable. Plus, you will not get the benefit of indexation as well. Moving on to the second one, from the interest income and dividend income, no deduction under 28 to 44, C or 57. You cannot claim any direct expenses as a deduction from both the interest incomes and the dividend income. That also means from long-term capital gain, you can definitely deduct direct expenses and cost of acquisition as a deduction. From the long-term capital gain, you can deduct the direct expenses and cost of acquisition as a deduction. Now note chapter 6A deduction from both the interest income, dividend income and long-term capital gain. From the long-term capital gain, dividend income, interest income, you cannot claim any chapter 6A deduction. And one more advantage is there. If the assessee only have dividend income and interest income as above, assessee only have what? Dividend income and interest income as above, and TDS has been correctly deducted, then no need to file your return. You don't have to file your return if you only have dividend income and interest income and TDS has been correctly deducted as well. Then you don't need to file any return as well. That's what the department say. And the rate of TDS is mentioned under section 196C. The rate of TDS shall be applicable at 196C and the rate shall be 10% plus surcharge if any plus health and education cess. That's what the rate mentioned under 115 AC, not 115C, 115 AC. So can you just have a plain reading over the provision? Okay friends, so now let's solve some question. So I want all of you to go through this question number 13. It's actually your July 2021 6-mark question. Okay, it is tested in July 2021 and it has been tested for 6 marks. So I want all of you to go through this question number 13 and give me the answer. Just read the question and give me the answer. Let's read the question and solve the answer together. So, Cherry Limited, a non-resident German company, has the following incomes in India during the year ended 31st March 2024. Dividend income of 12,50,000 from XY Limited, an Indian company listed on recognized stock exchange. So, Cherry Limited is a foreign company, and first of all, they have dividend income. And as you know, how much is the dividend income? 12,50,000. So, we will write this in a format. Say, the format which I normally recommend is particulars, amount, rate, and basic tax. This format will save your time, and this will actually help you to give right answers always. So, dividend income, as you all know, dividend income is subjected to what rate of tax? What should be the rate of tax for the dividend income from an Indian company, which is under section 115A. The amount is how much? 12,50,000, right? 12,50,000, and the rate shall be at 20%. And can you help me in computing the basic tax liability? How much is 20% on 12,50,000? 2,50,000, right? So 2,50,000 will be the basic tax liability. So in this manner, if you compute, at the end you will get both the total income and basic tax liability. Then you apply surcharge if any plus cess, you will get the final answer. Again and again, you don't have to read the question. Okay, this will actually help you to save your time in exams. So point number 2, 8% debentures of 20 lakh received from X Limited, Indian company, on 1st October 23 in consideration of providing technical know-how. So they provided some technical know-how, and in return they got what? Debentures, 8% debentures of having a value of 20 lakh. So that 20 lakh debenture is actually a consideration for the technical know-how. So we can call it as FTS. So we will call it as FTS. Now you tell me, if there is an FTS received by a foreign company, first of all you have to check the applicability of 44DA. 44DA will not be applicable here because they are not mentioning anything about PE and its effective service and all. So ignore 44DA. How about 115A? Is 115A applicable? The question is not mentioning that there is an agreement with central government or there is an agreement with Indian company. That is missing. Yes or no? So what you can write is, it is not covered under 44DA, not covered under 115A. So it will be taxable as a normal income as per the normal rates. So FTS, how much is the FTS total income? 20 lakhs is the value of debenture got. And the rate of tax, normal rate. That is at 40%. Okay, it's not 115A, not 44DA. So you have to tax at 40%. How much is 40% on 20 lakh? How much is 40% of 20 lakh? 8 lakh. Now moving on to the next one is interest on debentures. On the debentures you will get interest also. The debentures has been issued on 1st October. So you will get 6 months interest. So 8% on 20 lakh. How much is 8% on 20 lakh? 20? No, not 20,000. 1,60,000, right? It should be 1,60,000 is for the whole year divided by 50%. So 1,60,000 for 6 months. That means 50%. That will be 80,000. Yes, 80,000 will be the amount. And what is the rate of tax? Again, normal income. Being foreign company taxed at 40%. How much is 40% on 80,000? 32,000. 40% on 80,000 will be 32,000. Are you all with me? Now, moving on to the third item, dividend received 5,50,000. They use the word received. So, what do you mean by the word received? Normally, the word received means net of TDS. Yes or no? You will get an amount net of TDS. So, when you write the income, you have to gross it up. Or you can write an alternate assumption. I am assuming that TDS has not been deducted. You can take alternate assumption. Either you consider it as net of TDS, or you write your assumption that it is gross amount. I am not considering the TDS. You can write in both ways. So here I am assuming that it is net of TDS. So what you can write is dividend from GDR. The amount is 5,50,000. Now you tell me, what is the rate of tax for this? 10%. Are you with me? So the TDS will be 10% plus 4%. Always there will be cess. Are you with me? So how much is the effective rate of TDS? 10% plus 4%, that will be 10.4%. And this 5,50,000 will be how much? 89.6%. Yes or no? Because already 10.4 TDS has been deducted and you received 89.6%. So 5,50,000 into 89.6%. Can you help me with the math? How much will be the gross income in such a case? 6,13,839. And it is taxed at what rate? Under section 115A(c) at 10%. How much is 10% on this? 61,384. Then, what is the next point? We have considered dividend income. Business income of 8 lakh from unit established at Mumbai. So, it's a normal business income taxed at 40% normal rate. So, how much is 40% on 8 lakh? 3 lakh 20,000. Then, income by way of royalty other than referred under 44DA amounting to 10 lakh received from X Limited, Indian company in pursuance of an agreement approved by central government. So, 44DA, it's not covered under 44DA. So, normally it will be covered under 115A. And what is the rate of tax under 115A? 20%. The DTAA rate is 22%. So, whichever is more beneficial as you can choose. That means 20% under 115A only. So, it is royalty under section 115A. And what is the amount? They are using the word again, received. So, if they are using the word received, you need to gross it up. Because one question, one assumption. You have grossed up earlier, now you have to gross up this also. So, the rate of tax is basic tax 20%, cess 4%. So, effectively it will be 20.8%. So, this amount will be 79.2%. Yes or no? So, what you can do is royalty under 115A. How much is the amount? It is 10 lakh, right? So, 10 lakh divided by 79.2%. Can you help me with the math? How much is 79.2 divided by 79.2? 12 lakh 62,626. Under section 115A taxed at 20%. How much is 20% on 12 lakh 62,626? 525. Now, can you help me in computing the total income of assessee? How much is the total income of the assessee? Come again, 16 lakh, not 16 lakh, 60 lakh maybe, right? 60 lakh, 6,465. How much is the total basic tax liability? Can you help me in the math? How much is the total basic tax liability figure coming? Yes, how much is the basic tax liability total? Tell me. 17 lakh 15,909. Yes, so 17 lakh 15,909 will be the total basic tax liability. Now it is subjected to what? It is subjected to cess at 4%. How much is 4% cess on this figure? 68,636 rupees shall be 4% cess. And how much will be the tax liability? 17,84,545 shall be the tax liability as per this question. I hope it is clear for you. Okay friends, now we will complete the rest of the sections in NR taxation. We have two more main sections in NR taxation. After that, we will march towards DTAA. So moving on to the next one friends, section 115AD, that is special provisions for computing tax on income of foreign institutional investor from securities or capital gains arising from their transfer. So this particular provision, that is 115AD, is applicable for foreign institutional investors and for certain specified funds. So please listen. First of all, the section is 115AD. It is applicable for FII and specified funds. Now the question here is, what do you mean by specified fund? You know what is FII, that is foreign institutional investor. The question here that we are about to ask is, what do you mean by this specified fund? So let's understand what exactly is this specified fund. Two category of persons are normally called as specified funds. There is a definition for the word specified fund, but that is under the exemption. Under the exemption, there is a thing called section 10(4)(d), which is in page number 58 in our book. Okay, page number 58 in our book, there is an explanation, or there is a section called 10(4)(d). Under 10(4)(d) exemption, I am explaining what exactly is the specified fund. So let's understand what is specified fund. So two types of persons are normally called as specified fund according to the income tax law. Two category of persons are normally called as specified funds according to the income tax law. Number one, if you are a company, LLP, trust or body corporate, or a body corporate incorporated in India. You have to be a company, LLP, trust or any body corporate which is incorporated in India. Plus, you should have AIF category 3 certificate from SEBI. What is AIF? Alternate Investment Fund. AIF simply means Alternate Investment Fund category 3 certificate from SEBI. That means you are an investment fund and you are having a certificate called as AIF category 3, plus you have to be located in IFSC. What is IFSC? International Financial Service Center. You are located in IFSC and all the unit holders are non-residents except sponsors. So the first category of specified fund is actually very simple. If you are a company, LLP, body corporate, etc., incorporated in India, having AIF category 3 certification, you are located in IFSC and your unit holders are non-residents except sponsors. If you are in this category, you will be called as a specified fund according to the income tax law. And one more category is there, and the second type of person is, you are an investment division of an offshore banking unit. What do you mean by offshore banking unit? Onshore means in India. Offshore means outside India. Say HSBC, Hong Kong and Shanghai Banking Corporation. They have an investment division and they are about to come and invest in India. As a foreign portfolio investor, they want to grow their portfolio. They want to grow their wealth so that they are coming to India and investing. So those items or those people can be called as what? FPIs. This FPI, that means if you are a investment division of a offshore banking unit having a category 1 foreign portfolio investor category, which is categorized by the SEBI, that is FPI classification 1 certificate, and you are located in IFSC and you start your operations before 31st March 2024. So two types of specified funds are there. One, company, LLP, trust or a body corporate incorporated in India, plus having AIF category 3 certification, plus located in IFSC, plus all the unit holders are non-resident except sponsors. Number two, investment division of an offshore banking unit having category 1 FPI certificate located in IFSC, which started its operations from before 31st March 2024. These two persons are normally called as what? Specified funds. Are you all with me? These two persons are normally called as what? Specified funds. Now, these specified funds and IFSCs, if they are having some type of income, it will be taxable under 115(a)(d). That's what we are about to discuss right now. So, the section 115(a)(d) is applicable for both specified funds and FIIs. So, let's understand. Listen, what is the first point? Can you read the first point along with me? Income from securities. If you are an FII, then the rate of tax is at 20%. If you are a specified fund, rate of tax is at 10%. So, if you have any security and you are having some income from securities, then the rate of tax if you are an FII shall be 20% and rate of tax if you are a specified fund shall be 10%. And hope you know what is specified fund. The two types of persons under 10(4)(d) is said to be specified funds. Now, there is an exception to this point. Let's understand what exactly is the exception. Hope you remember 115(ab). What was 115(ab)? Can you check and tell me what is 115(ab)? Yes. 115(ab) is applicable for offshore financial organization. Are you with me? Or overseas financial organization, not offshore, overseas financial organization. So you tell me, An overseas financial organization can be an investment division of a bank also. An investment division of a foreign bank also can be called as overseas financial organization. Yes or no? Say for example HSBC. HSBC can be called as an OFO as well. Now HSBC's investment division located in SEBI having a FPI category 1 certificate can be called as a specified fund as well. Yes or no? So a specified fund can be an OFO as well. And what they are saying is income from security. Security means mutual fund unit is also a security. Okay, what if this HSBC being an OFO as well as a specified fund having investment income from UTI or mutual fund, whether it is taxable under 115 AD or is it taxable under 115 AB? The answer is it will be taxable under 115 AB. If AB and AD comes together, AB will override AD. That is the point. So that is the first thing. Income from mutual fund or UTI which is referred under 115 AB shall be taxed at 10% for OFO. Why? Because OFO can also be called as a specified fund. Why? Because specified fund means the second type of specified fund is a investment division of a offshore banking unit. So that can be called as an OFO as well. So if AB and AD comes together, AB will override. Are you all with me? Because mutual fund units can also be called as securities. You have income from that security, it will be taxable under AB only at 10%, not at 10% under AD. Even though the rate is same, but if a question comes in examination, you have to write the section. The section will be AB. That's it. Now, moving on to the next point. Hope you remember 115A. 115A, if you are an FII having some interest income from government security or rupee denominated bond or municipal debt security, then we have studied the rate of tax is at 5%. Yes or no? This rupee denominated bond and municipal security is basically a security. So you are having interest income from security as per 115A, then the rate as per 115A will prevail. It's not taxed under 115 AD. So AD have two exceptions. Number one, for OFO, AB will prevail and 115A also will prevail over 115 AD. Are you all with me? So friends, it's very simple point. Listen, we will repeat that again. What 115 AD says, if you are an FII, all the income from security taxed at 20%. Okay, for an FII, rupee denominated bond, then municipal debt security, and then government security. These are also securities. If you are having interest income from these three, it will be covered under 115A and the rate of tax will be at 5% as per 115A. That's it. So, second one, specified fund. All the interest from security shall be taxed at 10% under AD except OFO having investment income from mutual fund will be taxable under 115 AB at 10% only. Are you all with me? Great. So moving on to the next one, let's understand what exactly is the next one. Before that, can you read that first box by yourself? Alright friends, so moving on with the next one. What is the next one? Say you are an FII or a specified fund and you are transferring the securities and there is short-term capital gain on transfer of securities. Then the rate of tax shall be at 30%. That means if you are an FII or a specified fund and you are transferring any security, then the rate of tax applicable shall be for you under 115 AD shall be at 30%, subject to one exception. What is that? If you are transferring listed security like listed share or something, then the taxability will be under 111A. And what is the rate under 111A? It is at 15%. That is the only exception to 115 AD in relation to short-term capital gain. How about long-term capital gain? Let's understand what is there in long-term capital gain. Long-term capital gain on transfer of such security, FII and specified fund, the rate shall be at 10%. If you are transferring any security and there is long-term capital gain, it is subjected to a rate at 10%. And there are certain exceptions. What is the exception? If the security is a listed security, then the rate of tax will be under 112A. And what will be the rate? At 10%, that too over and above 1 lakh. Hope you remember we have studied or we have discussed it under capital gain. It is basically under capital gain under 112A. Now, If they have any other income apart from this, then the rate of tax shall be at normal rates. If they have any other income apart from the above, normally they don't have, they cannot have. But if they have any other income apart from this, then the rate of tax shall be at normal rate. That's it. Alright, so this is all about 115 AD. I hope it is clear, but not yet over. We have certain other conditions while computing this income. So listen. Now the next question is, can you claim expenses as a deduction? The answer is all the expenses from 28 to 44C and under section 57 not allowable. But while computing long-term and short-term capital gain, you can claim direct expenses and cost of acquisition. That is not at all a problem. But from income from units, you are not supposed to claim any expenses as a deduction. Moving on. Second one, first proviso to section 48, conversion reconversion procedure. For investment income, that means income from UTI, it's not applicable. From long-term and short-term capital gain, not allowable. If the taxability is under 115 AD, you are not supposed to follow what? Conversion reconversion procedure. And you cannot claim the benefit of indexation as well. Chapter 6A deduction, gone, not allowable. No chapter 6A deduction from both the incomes, whether long-term, short-term or investment income. And how about indexation? No indexation for long-term. How about conversion reconversion? No conversion reconversion for both long-term and short-term. How about the other expenses? Long-term and short-term, you can claim direct expenses and cost of acquisition. But from the normal investment income from securities, you cannot claim any expenditure as a deduction. I hope this much is clear for you. This is how you have to compute 115 AD. I hope that is clear. Moving on to the next section, we have the last section, that is the last flat rate under NR taxation, that is section 115 BBA, special provision for computing tax on non-resident sportsmen or sports association. So listen, if you are a sportsman who's not a citizen as well as not a resident, non-resident, non-citizen sportsman, and you are having income for participation in any game or sport in India. Say you are a sportsman, that to a non-citizen, non-resident. Say for example, Glenn Maxwell, he's an Australian cricket player, comes to India for playing IPL. For playing IPL, he's in RCB. RCB have to pay him an amount for paying in IPL. Yes or no? That amount received by Glenn Maxwell is definitely taxable in India. Why? Because that IPL is in India. So it is accrued in India. Glenn Maxwell have to pay at rate of 20% on that particular income that he received for participating in any game in India. That's what they are saying. Not yet over. If the Glenn Maxwell is acting in an advertisement, then all the income that he gets in relation to that advertisement is also subjected to 20% rate of tax. Not yet over. If Glenn Maxwell is writing some sports article in a newspaper or a magazine or journal, for that he is getting an income that also is subjected to what rate? 20%. So three types of income earned by Glenn Maxwell. Which are the three types? Number one, for participation in match. Number two, for acting in advertisement. Number three, for writing sports related journals in newspaper or magazine. If he is earning any income for these three services, those incomes are subjected to 115 BBA. And what is the rate of tax? Only 20% is the rate of tax. Not yet over. We have a few more items under this. Moving on to the next item, say for example, you are a non-resident sports association or institution. For example, say Cricket Australia. Cricket Australia came to India and they agreed to play a match with our Indian cricket team, with BCCI. So Cricket Australia will be remunerated. Once they come to India and they play one ODI or some 2020 games, a portion of the revenue have to be shared to the Cricket Australia as well. So if Cricket Australia or any other sports association is earning any income from India, then that is also subjected to what rate? 20% rate of tax. Cricket Australia was just an example. It can be any other sports association, just like a football association or hockey association or whatever it is. Are you all with me? So if you are a non-resident sports association or institution earning some income from India, that income is subjected to 115 BBA. And what is the rate of tax? 20%. And what is the last item? You are a entertainer who's not a citizen, not a resident. Entertainer means, say for example, Justin Bieber came to India and performed an event. For that, he is getting some remuneration. So if he's getting some remuneration for his performance in India, that also will be subjected to what rate? 20% flat rate. That's what the department says. So 3 types of persons, different types of income. Sportsman, non-citizen, non-resident. Match game, then advertisement fee and newspaper article fee. Everything taxable at BBA at what rate? 20% rate. Second one, NR Sports Association or institution. Whatever income they earn from India, subjected to 20%. Non-resident, non-citizen entertainer for his performance in India, whatever income he earns, subjected to 20% rate of tax. This is what the department says. Now, not yet over. Say for example, Glenn Maxwell or Justin Bieber took a lottery. Okay, lottery and they won the first prize. They took a lottery and they won a first prize. Or they visited some casinos in Goa and they want some income. Those incomes are casual income. You cannot call it as sports. Don't call it as sports. These are basically casual income and subjected to what rate? 30% rate under section 115 BB 30%. Okay. Now, while computing income under 115 BBA, assessee cannot claim any expenditure as a deduction. This is gross income based taxation. You cannot claim any expenditure as a deduction while computing the above income. You cannot claim any expenditure as a deduction while computing the above income. That's what the department says. I hope that point is also clear for you. You cannot claim any expenditure as a deduction. Moving on to the next one. If assessee does not have any other income, that means Glenn Maxwell, we will take the example of Glenn Maxwell. Glenn Maxwell only have those 3 incomes, which is mentioned under 115 BBA, and TDS has been correctly deducted. Then Glenn Maxwell is not supposed to file his return in India. If assessee does not have any other income plus TDS has been correctly deducted, then you don't have to worry about filing return in India. That's what the department says. I hope that point is also clear for you. So friends, let's solve a question. So I want all of you to go through this question number 10. Okay, go through this question number 10 and give me the answer. It's a fantastic question. It has 4 sub questions. Go through that paragraph and answer all the 4 sub questions. So friends, let's understand what exactly is the question. Smith, a foreign national and a cricketer, came to India as a member of Australian cricket team in the year ended 31st March 2024. So he came to India. He received 5 lakh. Again, they're using the word received. So you have to write the assumption. Either you gross up or you consider it as your final income without TDS. In the ICA study material, they have been assumed otherwise. They are saying that it is the full income. They are not at all mentioning about any TDS factors over there. Are you with me? So different questions, they take different approach. So it is always better to write your assumption. If you are assuming that it is net of TDS, that is also fine, but you have to write the assumption. If you are assuming otherwise, that means there is no TDS deduction, it is a full amount. There also you have to write the assumption. So here they received 5 lakhs for participation in matches in India. So you tell me how much is the income that he got? 5 lakh. So that will be subjected to 115 BBA because it is participation in matches. He also received 1 lakh from advertisement on a TV product. So 1 lakh again TV advertisement. He contributed articles in newspaper for which he received 10,000. That is also an item taxable under 115 BBA. When he stayed in India, he also won a prize of 20,000 from horse racing in Mumbai. That will be casual income. And he has no other income. Compute the tax liability of Smith. So these 3 will be subjected to 20% and this will be subjected to 30%. Can you help me with the math? How much is 20% on 6 lakh 10? 20% on 6 lakh 10 plus 1 lakh 22,000 plus how much is 30% on 20,000? 6,000. So altogether your basic tax liability will be 1 lakh 28,000 and on that there will be a cess of 4%. How much is 4% on 1 lakh 28? How much is 4%? 5,000, 5120 and altogether it will be 1,33,120 will be the tax liability in, that is the answer for question number 1,33,120. I hope it is clear. Moving on. Are the income specified above subjected to deduction of tax at source? The answer is yes. These 3 incomes is subjected to a rate of 20% plus 4% cess, because if the pay is NR, you always have to consider cess also as a part of your TDS. So 20 plus 4% cess, it will be effectively 20.8%. It will be 20.8% effective rate. And how about the casual income? It is subjected to TDS under 194BB at the rate 31.2. From where this 31.2 came from? 30% basic tax plus 4% cess. Effectively, it will be, don't say 34. On basic tax only, you have to apply 4% cess. So, it will be 31.2. That's it. So, TDS applicability is there. Is he liable to file return of income for assessment date 24-25? The answer is yes. Because even though TDS deduction is there, he have casual income as well. If his income consists only of income mentioned under 115 BBA and TDS have been deducted, then no return. In this question, his income, total income consists of casual income as well. Even though there is TDS deduction for the casual income, doesn't matter. You have to mandatorily file as return. That's what is the point is all about. I hope that also is clear. Moving on to the last point. What would be his tax liability had he been a match referee instead of a cricketer? If he is a match referee instead of cricketer, then match referee is considered as a normal professional, not a cricketer or a sports player. So, for match referee, this 5 lakh plus 1 lakh plus 10,000 will be subjected to slab rates, not BBA rate. And the casual income will be anyway subjected to 30% only. So, we can write like that 5 lakh plus 1 lakh plus 10,000, that is all together it will be 6 lakh, 10,000 will fall to the slab. Forget about BAC, okay? Forget about BAC. If it falls to the slab, you tell me how much will be the basic tax liability. 6 lakh 10,000 to the slab, you tell me how much will be the basic tax liability. If it falls to the normal slab rate, then up to 2,50,000 nil, 2,50,000 to 5 lakh, 5%, 5 lakh above 20%. So, the effective rate will be 34,500. And there is one more income, 20,000 into 30%, that will be 6,000. So, 6,000 also basic tax will be there. So, altogether 40,500 and it is subjected to cess at 4%. How much is 4% cess on 40,500? 1620. So, altogether your liability will be 42,120 will be your total tax liability if you are a match referee instead of cricketer. I hope that also is clear. And a similar question has been tested, much easier question, okay, not similar, exactly same question, much easier question have been tested in which year, 1 second, let me take that question. Yeah, it is in December 2021, 6 marks. It's just like a gift, okay. A similar question has been tested, which is comparatively more easier, which less number. Advertisement TV, participation in match, then newspaper contribution, winnings from horse race. These are the 4 items. You can quickly finish off the answer and grab 6 marks. Okay, that's it. So, by this I can say the most important concepts under NR taxation is completely over. I hope you got a grip over the flat rates and the other provisions as well.
To purchase recorded lectures and textbooks, visit our website www.cajoscurian.com.